lot of companies are quite uncertain about where things are going.
We've heard more companies talk about mitigation tactics for tariffs.
That strategic ambiguity is really aimed at other trading partners, and the message is not for the business community.
It's this uncertainty that is really, I think, killing the economy right now.
The concern is less worried about uncertainty, more worried about certainty of reality being bad.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, marking 100 days of the Trump presidency.
This is the best, they say, 100-day start of any president in history. My taxation and tariff policies, which are policies of common sense, we'll get along with China. They want to make a deal, and it's going to be a fair deal. I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I know much more than he does about interest rates, believe me. In the coming weeks and months, we will pass the largest tax cuts in American history. Our golden age has only just begun.
100 days, 142 executive orders, lower crude prices, a stronger border, and trade tariffs. A lot of tariffs. The trade policy weighing on the president's approval rating, weighing on markets and the outlook for the economy. The White House now looking to pivot to trade deals to tax cuts.
Well, there seems to be a recognition, at least, of some of those polls and the fact that there is a flood the zone going on with all of the people in the cabinet coming out and talking about, let's say, Howard Lutnick. There is a deal imminent, just, within days we're going to get something. And this pivot that we've seen with respect to auto tariffs, saying, look, we recognize we've been talking with the auto companies. We're going to gently ease into this so they're not left without a profitability mechanism. At the same time, the companies are saying, look, we don't know how to value any of this stuff.
GM is a fantastic example of that in the last 24 hours. GM delaying the earnings call because they wanted to get some clarity on a change in policy, which speaks to this idea that for some companies, for many industries, the fate of this economy, the fate of this market, in the hands of one man.
And in the hands of one man who they are having active conversations with and pleading with, and maybe are getting some audience. Yesterday, Howard Lutnick, the Commerce Secretary, said that the changes that were implemented to the auto tariffs stem directly from ongoing everyday conversations with these auto CEOs, with President Trump, at a time when they want to shift the scene, where they make more parts in the United States, but they recognize, okay, if they do this overnight, that's going to bankrupt some of these companies.
We've seen a lot of outlooks suspended in the past couple of days, suspended in a way that we haven't seen since the days of the pandemic. So what are the similarities? Here's the difference. The difference is the president has the vaccine right now. He can switch the virus on and off whenever he likes. That's the biggest difference between now and the pandemic.
There is this sense that this is a self-imposed kind of supply shock. At the same time, there is a growing amount of doubt about how quickly you can turn that switch back on. We heard from toy manufacturers over the past couple of days saying there is an increasing risk that there are not going to be enough toys for Christmas because essentially they have to put the orders in now for the Chinese manufacturers to start the goods. Right now, companies are withdrawing guidance, as you said, at the fastest pace going back to the COVID pandemic. There is a sense that a lack of investment is going to have a drag on the economy, and we're going to see that today, potentially, or the initial feelings of that, with the GDP print for the first quarter.
Closing out a super volatile month of April. On the month so far, we're negative by just 0.9%. 0.91% on the S&P 500. If you went away for a month, you'd think this was just any other month. Amazing.
And if you went away for this month, a lot of people would say congratulations, you have less gray hair and you have a longer lifespan. Look, I think that right now you're looking at a market that is trying to reassess whether you've had a complete sea change in the structure and the understanding of the dollar, the understanding of the treasury market, or whether you just saw a basis trade unwind, a bout of volatility, the uncertainty that comes with typical negotiations that will consolidate into something more predictable. That is yet to be determined.
The future's negative this morning, softer by 0.1% following 6 days of gains for both stocks and bonds coming into Wednesday. Coming up on the programme, George Goncalves of MUFG with stocks on a 6-day winning streak, Max Kettner of HSBC on why he's staying underweight US equities, and John Murphy of Bank of America as Trump eases tariffs on autos. We begin this hour with the president using his 100-day address to renew his criticism of the Fed chair, Jay Powell. Joining us from Detroit, Bloomberg's Tyler Kendall. Good morning, Tyler. Once again, the president going at the Fed chairman.
Yeah, hey, John, good morning. And President Trump saying that he realizes he should not criticize the Fed chair, alluded to the central bank's independence, but saying that ultimately he thinks that he has a better handle or understanding when it comes to interest rates. Of course, it comes after last week. He said he had no plans or intentions to dismiss Jerome Powell, even after his NEC director, Kevin Hassett, suggested that they were studying the issue. But I can tell you that in the room, it really did feel like he was trying to shift the blame here as he wrapped it into a broader defense of his economic policies amid what has been a recent flurry of polling showing that American consumers are growing increasingly concerned with his economic agenda, particularly when it comes to the tariff fallout. Now, he did dismiss that polling as biased, and it was a rather receptive crowd. In fact, he got the biggest applause when he mentioned the 145% levy that's currently in place on Chinese goods, even if he himself has previously said that he thinks it amounts to a trade embargo. He really tried to make this speech about his efforts to boost manufacturing, considered to be a welcome sentiment in Macomb County, Michigan, where he was last night, because it is an auto hub. He very briefly mentioned those executive orders he signed yesterday designed to give some sort of easing to automakers when it comes to the impacts of tariffs. And he said that he signed those orders in order to give them a little bit more time before he, quote, slaughters them for not reshoring production. He said that this really is all about boosting domestic production in the United States, really ramping up the pressure on the private sector, which we know has sounded the alarm that it can take years to shift supply chains. And there have been concerns and worry to do so amid what has been just so much uncertainty. And John, I will leave you with this because it's actually how President Trump ended his speech. He tied his tariff plans, of course, into his tax cut agenda, saying that he will use tariff revenue to help bring more tax cuts to that reconciliation package. Also pledging that he's going to protect Medicaid. We know that's going to be a very important debate as Republicans on Capitol Hill get to work this week to draft that package.
Tyler Kendall in Detroit, Michigan. Tyler, thank you. We'll catch up with Tyler again in the next hour of the programme. Lisa, audience matters here. This was for the base. It wasn't for Wall Street. The focus on Wall Street at the moment seems to be deals, exemptions and tax cuts. Certainly not the kind of thing that the president was talking about yesterday with regards to the Fed chairman.
I think it's really important that you highlight the delta, because right now with the base, which is the majority of the Republican Party, these things still poll really well. So even though the polls have soured dramatically, President Trump still has the bulk of the Republican Party behind him. And there are a lot of people who agree with the ultimate goals of some of these policies. Nonetheless, Wall Street, wants to see how do you implement that without causing some of the biggest U.S. companies to either declare bankruptcy, see their profit margins completely slashed, cut jobs dramatically, and lead to something that looks like a recession.
Here's the latest on Wall Street this morning. Here's the take from George Goncalves of MUFG, writing the following: the moment of truth is upon us. For years, soft data has been dismissed and explained away. However, this time, markets cannot ignore the shift from weak sentiment to actual reduced economic activity. George joins us now for more. George, good morning.
Good morning. Good to be here.
Is it too soon to see that hard data break this week?
I think this is the pivotal week. We have GDP coming up today. We have NFP. I think we know April to remember, and the fact that we end with such a minor reduction, but the volatility was epic. I mean, this was on par. I've been doing this for many years. These are the critical years, critical months you won't forget. And so I think the damage has been done. I think the volatility, the uncertainty that it kind of unleashed, and just a paralyzing effect on business community, investors, it's really going to have a toll on the data going forward. But even on the backward looking, I mean, we're seeing wide ranges of GDP expectations. Look, we can all debate what's going through in the motivation of pivoting back towards blaming Powell for this. But I think the market's going to view this as a code. Whenever the president mentions Powell in any sort of kind of pronouncement, means that he knows the data is going to get worse. So it's going to be a deflection tactic. So I actually think that this means today's GDP is going to be back because the president knows GDP.
You said the damage has been done. What does that mean in terms of how you price that in and whether it's being reflected in market expectations as in the prices of stocks?
Well, look, stocks are one thing. The rates market has, I think, been, better clued in to the fact that growth will still dominate more so than concerns about inflation, but we might get both, and that's going to be the challenge, later in the year. I do think that this is the bad news becomes bad news moment where you look up and equity markets realize that reprieve that we've had, this nice sort of bounce and a move back higher in equities and consolidated after a big downward move, this might be the point where it's over.
Why do you think that we're actually going to start to see the bad numbers come out now and not in, say, a couple months from now? I was looking yesterday, for example, we got the JOLTS data. Quits level came in at the lowest level in about 3 years, the job openings, but the quits actually rose to the highest level going back to last July. How do you reconcile these different key points?
I mean, look, the thing is, we had already underlying weakness in the economy, and this just exacerbated it, right? I mean, January, February was already decelerating. March, the uncertainty was front and center, and then, of course, April crystallized that weakness. So I just feel like we had some inertia. We gave too much credit to the resilience of the economy. Now this is enough to kind of tip things over, in our view.
George, GDP is out this morning at 8:30, and you know how this is going to work. These are the estimates on the street. We're looking for a negative number. BNP Paribas looking for negative 0.6. Morgan Stanley looking for negative 1.4. We'll sit here and explain this away quite easily. This is the goods balance. This is trade. That's all that is. And the underlying GDP print's going to be okay. What would you say back to that? And how important is the optics of a negative sign before GDP?
Look, there was definitely some front-loading and pulling forward activity. Let's see how much the consumer did that on the PCE side. But look, you can look back to 2022. We kind of discounted away the 2022 negative GDP prints because the outlook still looks strong, and we were coming out of the pandemic, and there's momentum there. There was savings. The consumer wasn't tapped out. This is like a one-time hit. If we do get any sort of underlying strength, I think it's just like the end of the kind of conclusion of the growth phase.
A week today, the chairman has to deliver a news conference over at the Federal Reserve. A week today, he doesn't get to delay it like GM did just yesterday. What does he say?
Look, I think the wait-and-see approach is preferred, considering that they're really still struggling with the inflation outlook and how these things will kind of filter through on the tariff side and the timing of everything. The fact that we don't know when things are being implemented, how binding are they? I still think it's cautious. The best thing for the Fed would be to see a mixed outcome of data today as well as on Friday with the NFP. If we do really see the kind of that big downward slide that everyone's fearing, negative GDPs are nothing to kind of scoff at. These are big adjustments in its Q1. What's Q2 going to look like? So I think it will influence the Fed and tee up June. We still have June as our base case for the Fed to cut again.
Just going back to a question that we've been asking for the past couple of weeks. If we do get bad news, and bad news is bad news, do bonds rally?
Great question. I think what we witnessed in this past month was a clear breakdown of the Treasury market into three pieces. We have short-term Treasuries, longer-term Treasuries, and we have everything else in between, and especially with on-the-run, off-the-runs, which could be used by leveraged community to express certain RV trades. We clearly now know that there's three different Treasury curves, and it then has impacts on swap spreads, the basis, and so we're starting to really differentiate across the yield curve. I think that the short-term rally, the short-term part of the curve will definitely rally. It's not clear. I mean, the Fed cut 100 basis points last year, and rates went up 100 basis points. It's quite possible that we get resistance in the long-term sector coming down because the next thing they're going to pivot to, which you guys mentioned in the break, we're going to start focusing on tax policy and how are we going to pay for all this. And the bond market is going to command a premium, I think, especially the long-term sector.
I don't know what the problem is. Since April 2nd, bond yields are higher by 3 basis points. What did I miss? What
Nothing.
happened?
John, you know what? Go back on vacation, go back on the cruise, because let me tell you, it's been super calm. It's been nothing to see.
Some people would have swapped this for a cruise, including me, maybe. George Goncalves of MUFG is going to be sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. Some relief for the auto industry with President Trump signing a directive to prevent multiple tariffs from stacking on top of each other, while another order offered a temporary tariff offset on imported parts worth up to 3.75% of the value of American-made vehicles. The reimbursement will be reduced in 1 year and eliminated a year after that. Meanwhile, Super Micro shares are falling 15% in the pre-market after the company reported preliminary third-quarter results that fell well below short of estimates. Sales for the third quarter came in at $4.5 to $4.6 billion, missing the company's guidance of $5.5 billion. The server maker attributes the underperformance to customers delaying purchases. And Spain's power grid operator says a series of disruptions over just a few seconds triggered Monday's widespread blackout, which spilled over into Portugal. The investigation is ongoing as Red Electrica says it doesn't have a complete explanation. The Spanish government is not ruling out a cyber attack, although the operator denies any hacking. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, Amazon in the crosshairs.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. I will not speak to the president's relationships with Jeff Bezos, but I will tell you that this is certainly a hostile and political action by Amazon.
A hostile and political act. The latest with Annmarie down in Washington, D.C. in just a moment. From New York City this morning, good morning. 6 days of gains on the S&P 500, extending the longest winning streak of the year so far. Equity futures at the moment to close out April negative by just 0.1%. On the Nasdaq 100, we're down by 0.25%. Under surveillance this morning, Amazon in the crosshairs.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. I will not speak to the president's relationships with Jeff Bezos, but I will tell you that this is certainly a hostile and political action by Amazon.
So here's the latest. The White House lashing out at Amazon on a report they might break out the cost of tariffs for consumers, pushing the president to pick up the phone to Jeff Bezos.
Jeff Bezos was very nice. He was terrific. He solved the problem very quickly. And he did the right thing, and he's a good guy.
Joining us now from Washington, Annmarie, AMH, let's get straight to it. Was this an example, a flavour, a taste of things to come?
Well, potentially, Jonathan. I also think it's an example, if you're a corporate executive, of maybe not how to handle this presidency. What happened yesterday, I think the timeline is important. This was leaked or scooped by Punchbowl News, saying that this is what Amazon was planning to do, show the cost of the tariff that's going to be in addition to that product. And when the White House was asked about it, they said that this was hostile and political. And then, of course, we had the phone call with the president and Jeff Bezos. And then Amazon quickly put out a statement saying this was never approved. It was just under discussion. Compare that to what happened last week when we were all sitting around this table in Washington, D.C., and you had Walmart, Target, Home Depot. Those executives go into the White House, have a meeting with the president, and talk about the fact that they were concerned about raising prices, empty shelves, how this was going to be a hit to consumers, but they did so behind closed doors. So I think if you're in corporate America and you're looking at and you're concerned about these tariffs and how to deal with this administration, you're probably taking a cue from this episode and a lot of this drama to maybe pick up the phone and have these discussions in private.
Annmarie, later on this morning, we'll be having a discussion in public as the GDP print and is set to be negative. AMH, George Goncalves just said moments ago that this is why he's renewed his attacks on the Fed chair, Jay Powell. Are we looking for someone to blame?
Oh, absolutely. I think the president made it very clear yesterday that he will continue to blame the Fed. He will continue to maybe try to use, as RBC put it a few weeks ago, Jay Powell as the scapegoat if a lot of these policies go sour. And already you can see the president on defense when it comes to it. Yesterday, he said that person running the Fed doesn't really know what he's doing. I have a better gut and a feeling when it comes to interest rates. Already you could see the pressure building on this administration because, one, what are we getting? We are seeing them talk about the hype of these deals that can get done when it comes to trade. They're also going after the Fed. And I think, Jonathan, all of this has to do with the immense amount of pressure they might be feeling when it comes to, like, these meetings we are describing in public or private, when it comes to the likes of retailers, talking about the increase in hikes of goods. But because why? The polls are showing that Americans are dissatisfied at the moment when it comes to the tariff and trade policies.
Annmarie, down in Washington. More from Annmarie later on this morning. Still with us around the table, George Goncalves of MUFG. George, let's extend this conversation with regards to Amazon. I think this is important for the following reason. Will this influence the way corporate America responds to tariffs in the weeks and months to come? Will it prevent them from being able to increase prices? And if they do, will it prevent them from blaming trade tariffs?
I mean, I think it's probably influenced it already. We're seeing it through the CEO confidence and just sort of business plans and CapEx spending. ideas that are being put on hold at least. And so, I mean, blame games we can kind of debate like how that's going to all work out. But there's going to be some sort of pass through and some sort of impact on pricing. And so the question then, who owns that? Right. And I think that it's going to be a shared responsibility. We'll see. Actually, I think the consumer would appreciate that, especially if we knew that the other side was paying for it or not. But I think it's going to be a challenging sort of way of communicating.
There's another aspect of this, which is that futures for Amazon right after that statement dropped about 2.5%. They clawed it back as the day went on. And as we heard about the phone call between Jeff Bezos and the president. But there is a culture of fear that is slightly different in corporate America, where they don't want to speak out and become the punching bag for this president. As an investor, how does that change the investing thesis if there could be a direct attack should a corporate executive come out with something that was to the dislike of the president? Look, I mean, I think at the end of the day, investors are still going to see through things and look through medium-term expectations around earnings growth and really more back to the ability to grow. And yes, there's obviously these headlines create noise and potential disruptions. I think the investors are, given that we went through this month and we were just kind of discussing it around the table, the fact that we're only closing down this much, considering how much volatility we experienced, I think the markets will see through a lot of this. There is this sort of moment that President Trump has as he reaches his 100 days in office to redefine his presidency as pro-growth truly, and not necessarily the tariff policies that have been less growth-friendly, as many people have believed, which have been the hallmark of the first 100 days. Do you think that it is enough, with the tax cuts that have been put on the table and the deregulation that they've talked about, to potentially become pro-business once again, at least in the eyes of Wall Street? Look, the markets could be fickle, let's be honest. Sometimes we kind of overemphasize one point and then we can quickly change as long as there's follow through, as long as there's actual proof that we're going to have, if we do have a recession, again, we don't know. We'll see how bad GDP is later. If it's kind of like a short blip in and out, we'll see through a lot of this. But if it lingers, I think that it will matter. I think it's going to kind of put things on hold.
This goes back to the conversation, Lisa, we had back in November. We go back to the beginning again. It's about the deficit. It's about whether this bond market will act as a constraint around the ambitions on the tax side of this administration. And I think that conversation returns again because it went away for a little while. I think that that's exactly right. And I think that that's what people are going to be looking at. And today we get a refunding announcement as well from the Treasury. We're going to see how they finance it at a time where suddenly there aren't a lot of people who are willing to allow their programs to be cut in their states.
Yeah, so like in a vacuum, and if we kind of ignore how you're going to fund all this, then maybe you can ignore it. But if we now pivot towards the pro-growth measures, but you have to fund it and it's really expensive and the Treasury can't afford it, it becomes the fiscal governor. The U.S. has not had that constraint, I think, ever. It's more like emerging markets have that issue, not the U.S.
And usually when things get bad, the bond market rallies and it allows the developed market to act counter-cyclically. Will that be challenged this time around? These are all different conversations we didn't have back in the president's first term.
And that have really been called even more into the fore because of the price action that you missed while you were on a cruise over the past month. That really, it has been pretty volatile. I'm just telling you, it doesn't look like it right now, but it has been a pretty wild ride. And there have been some real questions and anecdotes about foreign investors pulling back some of their buying of U.S. assets. So if you get some sort of rally in the long end, is it just constrained? Is it not nearly as big as it previously would have been, which causes the U.S. to have to pay much more in interest payments?
The tax effort will be hard for that reason and others. We know that they're pushing for more than just the extension of current policy. Taxes on ticks, taxes on overtime. Those things, they tally up pretty quickly to some big numbers.
Especially because a lot of people are saying you can't cut Medicare, you can't cut Medicaid. Even the president saying that would torpedo his approval rating. So what are they going to cut? And if it becomes deficit spending, is that something that the fiscal hawks can get on board with? Do they have even the coalition to get this through by Independence Day, Liberation Day? What's next?
George, have you got a date in mind?
Look, I do think that right now we're giving a lot of benefit of the doubt. Look at the inflation market. Break-evens are, super sanguine. You have a little bit of a pop in the beginning of the year over the kind of the tariff hump. But it's been mostly real rates. Real rates, the real cost of capital for the U.S. has been increasing and has stayed elevated. We can't afford real rates like this. And if they were to go even higher from here, and term premium also as a function of that, I think the bond market will come back into kind of regulating things.
George, it's good to see you. Thank you, sir. George Goncalves there of MUFG. It's been a snooze, hasn't it, the month of April?
100%.
Bond yields basically unchanged. The equity market basically unchanged.
Go back in your cruise.
Up next, we'll talk to Max Kettner of HSBC on why he's still cautious on US equities. Live from New York, this is Bloomberg. Equity futures this morning just about negative. We're down by 0.2% on the S&P 500. On the Nasdaq, we're down by a third. The Russell, the small caps, just about unchanged. Some big movers out there this morning. With your morning movers, let's cross over to Danny Berger. Hey, Danny.
And John, starting with a big one to the downside, down more than 15.5 for Super Microcomputer. This was an AI darling. It runs servers that you need for your big AI projects, but it gave preliminary results that were much weaker than expected. It said that companies were delaying their big purchases. They were delaying their demand, hence why you got the miss. They're already down 60% so far this year with some concerns over governance. So that's Super Microcomputer. We also had results from Snap. Another really big decliner in the pre-market session, down 14%. It declined to give an outlook for this current quarter, saying that there were real issues with demand, that volatility meant that ad spending looked like it might be pulled back. Of course, that wasn't the case for Alphabet, so maybe it's a Snap-specific problem. Now, the last bit of earnings we got that's moving a share to the downside is Starbucks, down nearly 7%, 6.9%. Their results missed, and there's this concern that the turnaround isn't taking hold. The CEO, Brian Nichols, a new CEO, almost pleading with this market, saying, look, I know it's not showing up in the data, but our turnaround effort is working. For what it's worth, the CEO also saying that the company would not be rising prices at least through the end of their fiscal year, which ends in September, John.
Danny, appreciate the update. Three of the movers to watch for. And the opening bell, which is about 3 hours away. On our radar this morning, some tariff relief for autos. President Trump signing a directive to prevent a multiple levies stacking on each other and offering a temporary offset. The offset will reduce in a year, then will be eliminated by the following year. Could you make sense of what happened yesterday?
Essentially, this is the president saying, look, I'm going to go to Detroit. I don't want to deal with people who are saying, wow, why are you bankrupting our companies? We need to give them a little bit more time to bring their supply chains back to the U.S. So they're going to create these exemptions or basically remove the overlay of a series of tariffs in a way to just alleviate some of the cost. I just wonder how much this tells us about where his levers of exemptions can be, because ultimately the goal has not changed. He wants to bring manufacturing back. He wants the supply chains shifted. He just maybe is willing to give a year, 2 years now.
I think it speaks to the rollout and what could have been done better, what could have improved. The outreach could have happened before you actually came out with the tariffs, and we could have avoided the situation of the last month, because it feels like, I think they've basically told us, this was a consequence of the outreach they've had, the conversations they've been in with the automakers in Detroit.
It's also a real question about what the fate of the relationship between Mexico and Canada will be, because that's going to have to be part of it in some capacity. Is this still a China story? Is this a domestic production story? What is the capacity to do that? And how can you do that if the economy is in a soft patch? So there are a lot of questions that need to be answered, and it just goes to this ultimate angst of how the rollout has been effective or not in convincing people that this is going to ultimately be a good thing.
VW has got a China problem, that's for sure. Volkswagen, check this out. Earnings plunging 40% in the first quarter. Higher manufacturing costs and slow China demand weighing on the car maker's balance sheet. The German automaker leaving its 2025 outlook unchanged for saying it did not account for tariffs.
Yeah, so how can you really even have an outlook if it doesn't account for tariffs? What's notable is how much European automakers have all really struggled, except for Stellantis, which makes a whole host of cars in the United States, so they're a little bit immunized. But let's just talk about who has pulled their profit outlooks. We're talking about Mercedes-Benz, Volvo, GM, Volkswagen saying we're not going to pull it, but you know what? This doesn't actually account for anything that's going on currently in this world. So it shows how European auto manufacturers in particular have been really buffeted on both sides from some of these trade tensions.
Do you want an update from the cruise industry?
Please.
Norwegian Cruise see the softening in the forward booked position. That's the latest from them this morning.
Thank you. I appreciate that. Yesterday, they actually came out and they were saying Royal Caribbean said that they haven't seen any cancellations and that things have been really strong. So maybe this is just an issue of the very high-end cruises that go to the fjords up near Norway.
Possibly, which is something I'd be interested in doing.
100%. These are actually cruises that are really
get
interesting.
On board with.
I know. I agree
Disney
with you.
Disney kind of cruises.
I know.
Count me
Those
out.
are doing really well.
They're doing well too.
Yeah, but I think that the ones where you go.
They're also very expensive, you know.
I know.
When you hear what families spend at Disneyland, it's kind of ridiculous.
Well, and if you see some of these cruises, I actually saw the Icon of the Sea in person, and it is a town traveling on the water, and there are like 15 different swirly slides. And if I were a SAC-7, I would really have loved it, but I'm not.
That's how much interest I've got in that, like zero. Let's turn to this story. Republican lawmakers are meeting with House Speaker Mike Johnson today to discuss raising the $10,000 cap on SALT deductions. Negotiations on the new cap are underway, but no agreement has been reached. They are pushing for more than just the extension of current law.
And this shows just why this is going to be such a difficult tax plan. You have the likes of Michael Lawler of New York State. He is a Republican saying, I am not going to sign any bill unless you raise the cap on how much you can deduct under the state and local tax deductions. Then you have fiscal hawks coming out and saying, we cannot allow deficit spending like this for this type of tax cut. So who's going to win? How are they going to get everyone together? This is going to be cats in the bag trying to pull together some sort of coalition at a time where there's a real stress on both sides of the coin here.
That's the fight for the next 2 months down in Washington, D.C. That's the fight right there. Equity futures at the moment negative by 0.25% on the S&P 500. Tariff uncertainty continues to linger. Earnings report keep coming in. Max Kettner of HSBC is sticking with this. We remain tactically risk off and stick to our underweight stance on the US, but buying opportunities should come soon enough. Max Kettner of HSBC joins us now for more. Max, welcome to the programme, sir. You put out a note in the last week why washing machines matter. Let's start there. Why do washing machines matter, Max?
Yeah, I mean, number one, it was obviously a bit of clickbaiting, so I'm pleased to see that it worked with you, John. That's very good. But number two, it actually there was some truth to that actually, and some sort of underlying reason why we looked at it. Because when we looked at the washing machine tariffs in 2016 and 2018, in fact, we've seen quite a bit of sort of textbook-like behavior, what we would expect with tariffs. In 2016, when we had the anti-dumping order on China, for example, the overall imports of washing machines to the US didn't really change. It was only the imports from China that dipped, but worldwide imports actually, they were pretty stable. So we saw the classic substitution effect. There was also no effect on prices. That only came in 2018 when we saw the global tariffs on washing machines slapped on. And what you saw in advance for that, a couple months before that, activity went up. We saw this classic sort of front loading that people are also talking about right now. So people really rushing to buy those washing machines, and then imports really nosedived into those worldwide tariffs. And the same happened with laundry equipment CPI. So with prices on washing machines, they've actually went up by 10.5% straight after those tariffs were slapped on in February 2018. So the parallel that we were drawing really there is, I think people are a little bit too relaxed now in saying, well, you know what, the next couple of quarters, maybe consumers are going to dial back spending a bit, and maybe we're going to feel a little bit on spending and on capex. Whereas I do really fear that in the next month or two, so in May and June, we're already going to start to see some really, really disappointing hard data. And because the narrative at the moment is so entrenched in the sense that it's only a slowdown, it's not a recession, don't worry, it's just to soften the survey data, because of that really, really widespread narrative, in fact, I really do fear that a couple of hard data points are already, a couple of disappointing hard data points are already enough to really drive us a leg lower in risk assets.
Well, Max, we're expecting to see it this morning at 8:30 Eastern time in GDP, but that's just the math of GDP. With front-loaded imports, you're going to see that show up. You might get a negative print. Max, when you say it will show up in hard data, which hard data, when and why?
Look, that's exactly the point. 2 months ago, I could have argued, well, it's mostly consumer sentiment, right? It's only the soft data on the consumer sentiment side. So let's watch that kind of data. But now you've got labor market conditions down, right? So some of the surveys pointing to lower, maybe even negative payroll prints in the next couple of months. You've got CEO confidence down, capex intentions down. Whether you look at regional Fed surveys, you look at PMIs, you look at small business sentiment. So in fact, at the moment, I think it is way too widespread to say, well, let's just dismiss it as soft data weakness. In fact, now it's so broad-based that I'm looking at the hard data. I'm like, I don't really care. I'm not looking only at consumer spending now. It could come from anywhere. It could be ADP today. It could be GDP today as well. Let's face it, John, today, today, the GDP data, even if it is positive, even if that is the case, look, consensus is saying consumer spending is going to go down from 4% in Q4 to 1.2 in Q1 in a quarter where most likely consumers have actually front-loaded activity. And still consumer spending is expected to be only a touch above 1%. That's not good at all. So to me, it's not just consumer spending. It could come from the consumer side, could be on the labor market side, could be jobless claims during the summer, right? Some sort of residual seasonality that we've seen also pan out in 2023 and last year. Remember the SARM rule then in August, but the market played that already in June and July, the sort of the cracks in the labor market. So we could genuinely see it from actually a broad range of hard data, not just, well, I'm looking at retail sales, and if they don't disappoint, then my view is wrong. No, it's much, much more widespread now.
Max, I'm just struck by the fact that 3 months ago you were talking Goldilocks on steroids and U.S. exceptionalism nirvana, and that was basically the story, and you weren't going to fight it, and all of a sudden you're max underweight the United States, and you're looking at China as a place to really overweight in a significant way. How much of a decline would you need to see before those buying opportunities start to emerge?
Yeah, so some of our fundamental models, the gap between those fundamentals, what we're seeing, what's being priced in terms of growth expectations, top-down growth expectations, and what's priced into the equity market, think globally cyclicals over defensives, that gap is around 9 percentage points. So that really needs to be closed. I don't think it is enough if we're seeing things like Microsoft or Amazon or some of the Mag 7 disappointing and that then driving the equity market down. No, it is, in fact, really, particularly the cyclicals globally that are holding up too well, and particularly also in the US. So I think, you look at the US, things like consumer cyclicals, but also the Russell, things like small caps really are pretty decent levels to go underweight and to sell again at this point now.
I'm struck that at the end of last year, people were saying that the U.S. would be able to weather tariffs much more effectively than any other economy around the world. And all of a sudden, 100 days into Trump's administration, and that story has been turned on its head. And you're basically talking about overweighting everything else except for the United States. Why has that narrative shifted to such a degree that the pain will be maximally felt to the United States and U.S. assets rather than Europe, rather than Asia?
It's a great question. It's very, very different from what we expected perhaps 3 months ago. Remember, 3 months ago, we had the first tariff round with Canada and with Mexico. And, the narrative, or I think the broad consensus was, this is mostly negotiation tactic. And remember, this was all solved within 24 hours. We kind of freaked out. FX freaked out, right? We had the Mexican peso sell-off, the Canadian dollar sell-off. So most of the tariff effects were really absorbed in FX. But then it was resolved within 24 hours. So we all thought, okay, let's move on. This isn't really something to take seriously. This is mostly noise. No need to price that in. And if anything, it's going to hurt the others more than the US because it's just that noise. I think what we've all underestimated, including myself, is the kind of confidence and sentiment shock and the kind of broad-based confidence and sentiment shock that we've really seen in the US economy. Again, I think the only reason why we're talking about the ins and outs of daily tweets or, you guys were just talking about the autos and the kind of nitty gritty around those auto tariffs. The only reason why we can still afford to talk about that is because the soft data versus hard data narrative is still holding up, because we are not seeing yet the weakness in this hard data. And I think that's really where I'm scared about in May and in June, where we could be seeing the first cracks in jobless claims, the first cracks in the hard data. And because of that widespread narrative of it's just a slowdown, it's not a recession, it's just the soft data that is weakening. Because of that widespread narrative, I don't need to see the whites of the eyes of recession. I think it's totally enough for a bearish view like ourselves to see 2-3 hard data points disappointing. And already that narrative, I think, will be shattered.
Max, I just want to pick up on one trade in particular, just to close this conversation out. You've increased your overweight into EM local debt. There's two assumptions you're making here. That if the US economy gets into trouble, the rest of the world won't as much. And you're also making a call on the FX market as well, because typically when you see a global economy go into a downturn, the dollar strengthens. It doesn't weaken. Where do these assumptions come from?
I think that's totally right, John. I think most of that really is something, or is the assumption that it's mostly a US-centric risk-off, that it's a US-centric slowdown. Let's face it, in the last 2 months, we've also seen several puts from the US administration, so several sort of U-turns from the US administration. I don't expect this time to be any different. I don't expect that if the hard data really turns, if a view like ours is correct, that really the US administration will press on regardless. I do think there will be some sort of concessions to the market and some sort of U-turns where then is exactly precisely those kind of buying opportunities that you were alluding to in the very beginning. I think that's what we're going to see in the next 2-3 months. And that, of course, means it is not an environment where you want to go long the dollar and where you say, oh, that's the ultimate safe haven. It's mostly really a US risk off where the dollar sells off and where weirdly and oddly enough, this divergence between emerging market local rates and broader risk assets, think US equities, think global equities, that broader divergence we've seen in the last 2 months, that will still hold. And where a lot of emerging market, particularly high beta countries, think places like even Indonesia and Asia, but like South Africa, think Mexico, for example, a lot of those high beta names have a really, really attractive risk premium here.
Max, appreciate the call today. Max Kettner of HSBC. That call on EM local debt is quite something. And to explain it in the way that Max just did is controversial, to say the least, relative to what history looks like.
But he's not the only one. And actually, if you look at emerging market local currency debt, it actually has been one of the biggest outperformers so far this year. So to the extent that people are rushing into it, when I talk to EM portfolio managers, not really. At the same time, if you look at the performance, that's been the star.
The US slowdown on an island.
Yeah.
Let's see how that works out. Equity futures on the S&P. It's quite a call. Negative this morning by 1/3 of 1%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. President Donald Trump renewed his criticism of Fed Chair Jay Powell in a speech marking his 100th day in office. He said Powell is, quote, not really doing a good job and that he, Trump, knows more about interest rates than the Fed chair. Trump also championed his economic policies and tariff regime during the speech in Michigan. Meanwhile, Russian President Vladimir Putin is insisting on taking over more land in Ukraine as part of any agreement to end the war. Sources telling Bloomberg Russia wants to take control of 4 regions of Ukraine it doesn't fully occupy. The demand deals a blow to President Trump's efforts to reach a ceasefire. And another check on Starbucks shares. They are falling 7% now in the pre-market after same-store sales missed estimates as they declined 1% last quarter, while earnings per share also disappointed. Despite the weakness, new CEO Brian Nichols says the chain is making progress in its turnaround plans. China was a bright spot for Starbucks, with sales coming in better than expected. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, the President pumping the brakes on auto tariffs.
To help these automakers bring their factories home as rapidly as possible, I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the USA.
Our next guest is challenged with explaining that. John Murphy of Bank of America joins us in just a moment. From New York, you're watching Bloomberg TV. Six days of gains for stocks and bonds. Some losses this morning, small ones. Marginally lower on the S&P 500. We're negative by 1/4%. On the Nasdaq 100, we're lower by 0.4%. Big 48 hours coming up for the Nasdaq 100. 4 names, 1/5 of the S&P 500. Meta and Microsoft today. Tomorrow, Apple and Amazon. Futures on the Russell. Small caps just about unchanged. Under surveillance this morning, the President pumping the brakes on auto tariffs.
To help these automakers bring their factories home as rapidly as possible, I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. But just in case we can't get everything in time, we gave them a little bit. So it's 15% of the parts, and then it's 10% of the parts. We give them a little time before we slaughter them if they don't do this.
So here's the latest this morning. President Trump offering some relief to the auto industry, lifting a portion of duties on foreign-made parts. John Murphy of Bank of America writing, the level of uncertainty is very high and the situation is in constant motion, which provides a little visibility both in the short and long term. John joins us now for more. John, good morning.
Good morning.
Have you ever watched Margin Call? Do you remember that scene with Jeremy Irons when he says, explain it to me like I'm a golden retriever?
Yes.
Can you give it a go now?
Okay, so there's three things. There's the executive order, the proclamation, and what we didn't hear. So on the executive order, we got the destacking of tariffs. Somewhat helpful, right? Simplifies things. 25% tariffs on imports to the United States on autos and parts. The proclamation gave the U.S.-produced vehicles some relief for the next 2 years on importer parts. Varying degrees there, but Tesla and Ford are definitely benefited from that. Others are kind of disadvantaged to some degree. So those kind of the EO and the proclamation. What was not said was that we're going to get any restitching of the USMCA back together, and there is no relief beyond the next 2 years on auto parts. And right now there is no relief on imported autos. So basically we're looking at ultimately 25% tariffs on autos and parts sticking based on what we've learned right here. I mean, it's a little bit of relief, but it really creates a lot of problems for a lot of companies.
How much does that undermine their business model in a profound way at a time where they're also being tasked with building factories, building manufacturing capacity in the United States?
Yeah, I mean, I think this is very disruptive relative to expectations. And, there was an expectation that USMCA would get stitched back together and we get some relief on this 25% tariffs at some point. So what you're seeing from the German Lux company is them pushing out EVs, not necessarily canceling stuff yet, but pushing out sort of some of their EV introductions and scrambling to figure out how much money to invest in the U.S. and how much not to. Because remember, when we're talking about the auto industry, you're making a 1 to 5 year decision or 1 to 5 year out decision on committing capital and capacity. And then you're going to live with that decision for potentially 20 years or longer. So what we're looking at is an administration which theoretically will be in office through the 2028, 2029, there'll be a new administration. So you're getting some relief for the next couple of years, and you might have new rules in 3 or 4 years' time. So you're really kind of struggling as to what to do here with these massive capital decisions.
I remember just a couple of months ago, John asked whether the auto sector was uninvestable, given some of the uncertainty. Given this type of uncertainty and given the fact that the auto companies themselves are saying, we can't give you an outlook, we can't even give you a call, does that make them uninvestable right now?
Well, I don't think it necessarily makes them uninvestable. You have to take the risk, into the equation. And I think when you're looking at some of these U.S. domicile companies or like Ford and Tesla, they are kind of interesting. I think GM's got a lot of work to do. A lot of their imports are coming from Canada and Mexico. So we'll see if there could be some relief there. But I think this is what we're looking at through the economy in general, is just this ability to commit capital without knowing the rules of the game from investors. And investors are not just, the buy side, people allocating capital sort of on a raw basis, but it's the management teams, investing capital. So I think in every sort of leg of cap allocation and capital commitment, I think there's tremendous uncertainty, and it's not just in autos, it's everywhere. And you're seeing, folks freeze and push off these commitments.
Clearly, GM froze, to Lisa's point. They had to delay the call with investors and analysts alike in the media. What are your questions for them right now?
So I've been doing this for almost 30 years. I've never seen sort of this last-minute delay like this on a major company. I think the big thing for them is what are they going to do with their truck platform, which is really the big boogeyman for them at the moment. So they are producing that at a couple plants here in the U.S., but also Silao, Mexico, and Oshawa in Ontario and Canada. So are they going to bring some of that production back here to the U.S.? For them, that's kind of the big sort of bogey and thing that they really need to fix relative to the current situation. They're hiring in Fort Wayne right now. It sounds like their Orion plant, which was supposed to be Silverado EV, and just for EVs, is actually going to now potentially be doing ICE Silverados. So I think they're going to pull this together reasonably quickly, but those will be pulling jobs back from Canada and Mexico. So if you look at the administration and their goals to get jobs back to the U.S., the early days are auto sales are kind of booming because there's massive pull forward. There's more capital coming into the U.S. from companies like GM, Honda, Nissan, and there are more jobs coming back to the U.S. You look at this and you say, okay, I'm achieving all my goals. Why would I back off?
Are prices going up?
I think they're going to have to. I mean, I think what you're looking at right now is half the vehicles that are imported to the United States are subject to 25% tariffs. The other half are subject to some small tariffs on parts that are non-USMCA compliant and coming out in from outside of North America. So I think we're looking at, if everybody wanted to cover this bill completely, you'd probably be looking at something like a 10% average increase in price. The question is, are the automakers, to Lisa's question, going to eat some of this for now to fight through the next couple of years to get to the day where things kind of normalize and we're back to where we were before?
I don't know what normal is anymore, John. It's good to see you, sir. John Murphy there of Bank of America. The second hour of Bloomberg Surveillance up next.
The risks are on the downside, but it's a bit early to look for the real negative numbers in payroll.
The parts of the labor market that were really strong should start to slow down.
It does come down to the labor market. If we see that weakening, we think the Fed over time will react.
The hope here is that this becomes a political problem before it becomes a severe economic problem.
This is an environment where we have to kind of recalibrate to what's actually going on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures negative by 0.2% on the S&P, coming off the back of a six-day winning streak. A six-day winning streak and a gain of almost 8% over those 6 days on the S&P 500. 6 days of gains for stocks and bonds. Bond yields lower on a 2-year, 10-year, 30-year this morning by another basis point. Over the previous 6 days, a move of more than 20 basis points. Some comfort coming from fixed income, going into a big 24 hours for earnings and economic data. Earnings from the likes of Meta, from the likes of Microsoft. Data, GDP at 8:30 Eastern Time. Lisa, a lot of explaining to do in about 90 minutes.
There is the expectation by a number of Wall Street firms that this is going to be the first contractionary GDP print, the first negative GDP number going back to the first quarter of 2022. You indicated before, this is something of a math question in terms of just the trade balance getting really negative as a result of the pull forward, and that's the reason why. However, George Goncalves is saying bad news is bad news. You're going to see that reflected in markets, and you can feel the White House trying to get ahead of that.
The optics of it isn't great. I just wonder what the White House does today. For me, this is when you should be engaging with the public, with the media speaking to us and talking to us about what you see in the economic data and why this isn't a recession. You can explain that away to your point. It's a math question. Or do you just sit here and say, I'm not going to give this any oxygen at all, keep blaming the Fed chair, Jay Powell, and try and make it his problem?
You know, that seems to be, at least on the margin, something that President Trump is flirting with, although I'm sure his advisors have told him maybe ixnay on the Fed chair. They maybe back away from that one because this is going to be something very problematic for the markets, which we've already seen. Nonetheless, there is this feeling, and it's an inconsistent message right now from the White House. On one hand, they're saying it's going to be an indigestion period. They're going to say that there is an adjustment phase that has to come with creating a more sustainable outlook for the U.S. economy. On the flip side, they want to say that this is going to be a booming economy. How do they do both at a time of waning confidence?
BNP Paribas looking for something like negative 0.6% this morning. Morgan Stanley looking for something like negative 1.4% at 8:30 Eastern. The big one for us is really payrolls Friday. We've seen the cracks elsewhere. Are we expecting it to show up in payrolls on Friday, or is that still too soon?
You know, this to me is the key question. Torsten Slok saying that we really could see this given that the survey period was the week after Liberation Day, after that April 2nd announcement about the tariffs. You have seen on the margin some signs of people trimming costs and laying people off, but you haven't seen it in the numbers. And yesterday, the JOLTS data, the job openings data, really showed some contradictory information. On one hand, you saw the JOLTS, the job openings, fall pretty significantly. On the other hand, the quits rate actually rose, meaning that people were confident enough to voluntarily leave their jobs. Put those two things together and make sense of them, and please help me out.
Consumer confidence numbers pretty brutal as well yesterday. Ugly, the weakest since May 2020. Equity futures at the moment on the S&P negative by just 0.2%. Coming up this hour, Jim Caron of Morgan Stanley as stocks post a 6-day winning streak. Ryan Petersen of Flexport as President Trump marks 100 days in office. And the Facebook co-founder Chris Hughes on why Meta's antitrust trial is just the tip of the spear. We begin this hour with the president renewing his attacks on the Fed chair, Jay Powell.
And inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
Joining us now, Tyler Kendall from Detroit, Michigan. Tyler, you heard those comments. You were in the room listening to the president. I want to understand from your perspective, because we heard from a guest earlier on this morning, to Lisa's point, she mentioned it just moments ago, who said the president's looking for a fall guy when GDP drops at 8:30 Eastern time.
Yeah, hey, John. Well, in the room, it really did feel like President Trump was trying to shift the blame onto Jerome Powell, particularly because he rolled his criticism into a broader defense of his economic policies, and of course comes after the Commerce Department data yesterday showed a record U.S. goods deficit, which is implying and raising concerns about weaker growth in the first quarter. And also we have been getting, of course, those recent polling showing us as well that American consumers really are concerned here when it comes to the future of President Trump's economic policies, particularly amid the tariff fallout. Now, President Trump was speaking to a rather receptive crowd, really felt like he was trying to rally his base here. He even said that it made him miss the campaign trail, more broadly speaking. And that's because he was really trying to hone in on some of those issues that he knows would play well in a area like Macomb, Michigan, where we were, which is, of course, an auto sector, an auto-heavy industry and area. And President Trump saying that this is all in a bid to try to reshore manufacturing, even going as far to say that he could potentially slaughter the automakers, that was his words, if they do not reshore manufacturing and quickly. It's all playing into that broader economic agenda that we really have been trying to glean more details with when it comes to where this potentially falls in the future of trade deals. President Trump did say that he was making progress on those trade deals, but that ultimately he's ready to just set a tariff rate and walk away from the table if that's what he ends up deciding to do.
Tyler Kendall with the latest. Tyler, thank you. As always, you get the sense that he does really enjoy the campaign trail, maybe more than the White House. I think the words 2028, those numbers came up yesterday, didn't they?
Yeah, and he hasn't ruled that out. You know, he talked about loopholes, et cetera. Look, putting that aside, there is an interesting point that he's getting out on the campaign trail, or at least the trail, for the first time in 100 days. He's been sequestered in the White House and in Mar-a-Lago, and now he's trying to get his message out directly to the people. It just highlights whether he is going to see some of the disconnect that people feel, or whether the base really is welcoming all of the inroads that he's made with respect to the 100 days of tariffs.
What a month this has been. Never mind the 100 days. The last 30 days, investors looking to wrap up an incredibly volatile month of April for US assets. Jim Caron and Morgan Stanley writing the following. Are US Treasuries and the dollar still safe havens? The short answer is yes. The market is confusing the fundamental signals with technical noise from flows. Jim joins us now for more. Jim, what a 30 days. I can't think back to another month like it, where you see this much volatility and yet the equity market on the month is almost flat. Bond yields are almost flat. What's the takeaway for you and the team, Jim?
Well, it's about the journey, not the destination, maybe, is really what we're talking about. And I think what we're also trying to figure out is the amount of volatility and uncertainty that's come over the past, say, 30 days. Does that break things into the future? Does that create a higher unemployment rate? Does that weaken the labor markets? Everything that your guests have been talking about yesterday and today, it's really about the labor markets. It's about consumption. It's about all of these other factors. And the uncertainty from a business perspective for CapEx and for spending, does all of that get fixed? Does that get fixed over the next 30 days, 60 days, whatever it is, in order for us to have more sustainable, visible growth?
There are some correlations we need to fix as well, Jim, and they still feel broken. We were talking about this together down in Washington, D.C. last week. The conversation continued this week. Lisa was talking about it yesterday. The equity market and the bond market are still trading in lockstep. Now, Jim, we've repaired the damage in both asset classes. I understand that. But if you're looking for that ballast in the portfolio from treasuries, will it be there? Have we repaired the damage done there?
So this is a topic that's near and dear to me. I've been writing about this for a long time. We are going through a period. I have data going back 115 years that basically shows that the correlation of bond returns and equity returns are the highest they've been in the past 115 years, which means that bonds are no longer as good of a hedge as they used to be to equities. So when you put together a portfolio, say a 60-40 portfolio, where these two things are supposed to balance the risks with each other, what we're going to find going forward is if both returns are very highly correlated, that creating a diversified portfolio to balance the risks is not going to be as achievable. Now, the source of this problem that we're having, if you want to call it a problem, is the fact that inflation is stubborn and it's above target. And when it stays above target, say 2.5% or above, then that correlation is very, very high. I believe that we are going into a higher inflation environment, meaning that we're not going to be below or at target for an extended period of time, which means that the correlation of returns in bonds and equities are also going to be very high. So, John, this is a new way of saying this might be the new normal. We just have to recognize, and this is not untypical of the past. We've seen this many, many times in the past 100 years. We just have to get used to the fact that bonds are going to be more highly correlated to equity returns, and that building a diversified portfolio is now going to have to go more into thinking about subsectors, idiosyncrasies, names, specifics, all of the things that makes asset management, portfolio management really interesting, all the theory behind it. It's going to come into play now. We've had an easy ride for the past 20 or 30 years when correlations have been really low.
There's a subtle distinction here that you're making, Jim. On one hand, you're saying that U.S. Treasuries and the dollar are still haven assets. On the other hand, you're saying they might not be good investments. Can you square those two differences? The idea that maybe they're still safe haven investments, but right now they're not the ballast to your portfolio. They're not the place to protect against inflation. And maybe they're not even the place to really protect against geopolitical concerns.
Yeah, and look, I mean, to be clear, I mean, U.S. Treasuries, bonds, they're going to have a place in a portfolio, but to the extent that they're going to have the positive returns that they've had in the past, it's not likely going to be the case. So the safe haven status that we have to understand is that going back to 2010, post-financial crisis, there was an onslaught of investment into the U.S. from foreign countries, which meant that they sold, let's say, euros, they bought dollars, they bought U.S. equities. By the end of 2024, what we realized is that with tariffs and everybody being now overweight the U.S., that there's now an unwind, there's a repatriation, there's a rebalance. So these foreign investors into U.S. assets are selling U.S. equities, getting dollars, selling those dollars, repatriating back into local currency. And, again, let's use euros as an example. What that means is that if you look at the Fed's nominal trade weighted broad dollar index, not the DXY, but the Fed's index for this, it has increased substantially. It's up 40% since 2010. So yes, the dollar is devaluing, meaning it's weakening. It's not really devaluing, I shouldn't say that. It's weakening from very extremely expensive levels. And as the dollar comes down, what you're going to find to make that adjustment, Treasury yields will not come down as much. In fact, they might even go up a little bit. And that's just the balance. That's really what we call the capital account. And that's essentially what's taking place. This isn't a wholesale liquidation of U.S. Treasuries, a loss of safe haven assets. This is a global rebalancing from a very overweight position in U.S. assets in a very expensive U.S. dollar on many financial market metrics, such as the real effective exchange rate models that many people use. So there's a big distinction here that's being made. And I think there's a lot of conflated truths that are coming through that are basically saying that there's foreigners selling. That's not happening. There's a slowing of buying that's taking place, but there's also a rebalancing of these overweight positions. It's a very important distinction. So it's not that they're not good investments. It's just that we're just trying to find the right, treasuries, of course, are going to be a good investment, but we're just trying to find the right clearing price.
Jim, you're kind of painting a pretty bleak scenario, at least for returns, because if you can't necessarily get positive return from bonds, and you're talking about the potential for a negative GDP print that we might get in about an hour and 15 minutes, well, where do you go? Where is going to be the positive returning asset in your portfolio?
So, when we think about this, again, it's always about balance, right? It's always about a diversified portfolio. So it comes in steps. If I look at the front end of the yield curve, shorter duration bonds are still doing reasonably well. I mean, 2-year yields are staying low. It's controlled by the Fed. What I think is going to happen is the yield curve is going to steepen. So when you construct a portfolio, what you should probably be looking at is underweight duration, slightly shorter duration, hold shorter duration bonds, good quality bonds at short duration. Now, the other thing that's taking place, and this is going to sound maybe a little strange, but there's what I call an inflationary deleveraging that's likely taking place. The U.S. has gone through a big debt cycle. It has a very high debt to GDP right now. It's very likely with this higher inflation, it leads to higher nominal growth. And essentially that higher inflation creates more, dollars in the system. that typically goes into financial assets. So believe it or not, equities are actually an interesting destination. Now, you have to pick your sectors. You might not want to be overweight large cap tech perpetually, but if you diversify your equity portfolio into high quality, dividend paying, I think over time, that money, because when you have inflation around 2.5%, 3%, even 3.5%, equity valuations tend to stay relatively robust and high. And if you have a deregulatory administration that's coming in, that also helps boost, some of the potential profit margins. Equities can become a very interesting place. And as I like to say, to some respect, you might have to hold some equities to hedge your bonds, because equities will react a bit better in a modestly inflationary environment.
There we go. That's going to annoy a few people, Jim. We'll leave it there. Jim Caron there, Morgan Stanley. Really thoughtful stuff on portfolio management. In the last 24 hours, we're marking the first 100 days of the Trump presidency in his second term. He's done a lot of what he said he would do, particularly on the southern border and with regards to trade. But the foreign policy wins have been few and far between. The two most powerful images coming from this presidency so far are in reference to Ukraine. The Oval Office debacle and the scenes in the Vatican over the weekend between the leaders of Ukraine and the United States. Really quite poignant and the polar opposite of one another. This news right here speaks to that image right there. Ukraine ready to sign a natural resources deal with the United States, a deal that's been finalized and may be signed as soon as today.
And that comes after a real roller coaster of that hallmark meeting between the two that did devolve. It also comes after Vladimir Putin reportedly is demanding 4 additional locations in Ukraine to take control in order to agree to any kind of ceasefire. Is this President Trump putting more credence in the Ukrainian alliance ahead of any further negotiations?
Watch this space. The latest reporting here at Bloomberg on Ukraine and the relationship with the United States. Elsewhere, let's get you some top stories in your Bloomberg brief. Here's Yahara Hackers with more. Hey, Yahara.
Hi, John. UBS's market unit posted a record performance in its latest quarter as geopolitical turmoil spurs volatility that the bank says is set to continue. However, UBS warned that uncertainty over trade policy could cause businesses to put off investments, which would hurt its deal-making business. Meanwhile, Caterpillar shares have turned positive, up about 0.8%, even after the heavy equipment maker reported first quarter results that missed estimates. Caterpillar also said it could be facing a $250 to $350 million cost headwind from tariffs in the second quarter. And Norwegian Cruise Line Holdings shares are dropping 6.8% in the pre-market after its first quarter earnings missed estimates. The company reported a 9% drop in passengers carried compared to the same period a year earlier. And looking ahead, it says it has seen a softening in its 12-month forward bookings. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, shaking up global trade.
I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. We give them a little time before we slaughter them if they don't do this right.
That conversation up next with Ryan Petersen of Flexport sitting down with Annmarie in Washington, D.C. From New York, this is Bloomberg. Equity futures on the S&P negative here by 0.2%. On the Nasdaq 100 down by about a third. Under surveillance this morning, shaking up global trade.
I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. We gave them a little bit, so it's 15% of the parts, and then it's 10% of the parts. We give them a little time before we slaughter them if they don't do this right. China's taken more jobs from us than any country has ever taken from another country. They want to make a deal, and we're going to make a deal, but it's going to be a fair deal.
Here's the latest. Companies and investors awaiting clarity on trade deals President Trump mentioned in his speech last night. Joining us from Washington with a special guest is Annmarie. Hey, Annmarie.
Good morning, John. That's right. I'm joined with, of course, Ryan Petersen, the CEO of Flexport, a friend of the show. We're so happy to have him in person in D.C. You're in the thick of this trade story, representing all these companies that are trying to figure out where these tariff rates are going. We're going to get GDP numbers today that are going to show a tremendous amount of front loading. Where are we right now when it comes to shipping, especially in China?
Yeah, so Flexport is one of the largest logistics companies in the United States, in the world, really. And what we've seen since the tariff, since April 9th, is a 60% decline in bookings. That's not a Flexport number. That's industry-wide for ocean freight. Now, a booking is, you place a booking about 3 weeks before the container leaves China. And then it arrives, of course, in the U.S. about a month after that. So this all started about 3 weeks ago. You're going to start to see arrivals at the port of Long Beach drop from China by 60% in the next few weeks. And then weeks after that for East Coast ports, Gulf Coast ports. So it's going to be a massive impact on consumers, prices, and obviously, you know, the bigger impact here is companies and therefore jobs if they can continue to employ as many people.
And we've seen companies reach out to the White House. Last week, you had Walmart, Target, those executives in the Oval Office explaining this picture you're describing right now. And then yesterday, we had really this dramatic episode with Amazon. Amazon was going to potentially carve out the tariff price on their website, and the administration called that a hostile and political act. Do you tell your businesses how they should maybe deal with this White House when it comes to trade policy?
Well, you know, our businesses, Flexport customers are kind of mostly small, medium-sized business. We do work with a few large enterprises. I feel like they're able to handle relations with government on their own, but the small business really doesn't have a voice in all this. So it's kind of like been, to some extent, my role, our company's role is helping to tell that story, showing this data, making it clear, like, the impact is disproportionate on small business. Larger companies tend to have more resources to be able to multi-source the same product. They can buy it in Vietnam, buy it in other countries. So as China starts to become non-competitive, they just shift manufacturing. Small business doesn't have that luxury. They can't have multiple factories. They barely convinced one factory to produce their item, and they're kind of last in line.
When it comes to Amazon, though, and this entire debacle that played out yesterday, what we saw is Amazon come out almost immediately and blank and say, we were just doing this under discussion. We're actually not going to go forward with this. And this was, of course, after the president as well called Jeff Bezos. Was that the right reaction from Jeff Bezos and corporate America?
You know, I'm not going to tell the Amazon team how to do their job. They're pretty good at life. But I thought if it was me, I would be like, yeah, putting, you know, the tariffs on there to make it clear that Chinese products are not competitive. You should buy American products. Look, no duty on the American listings. And it could have positioned that as a win really easily. I don't know why they just backed off right away.
But Amazon, as you said, they're one of the bigger players. They'll be fine. What happens with these small businesses? Do we see businesses go bankrupt?
Yeah, definitely. I mean, if they don't change this policy, and Trump has hinted that they will, it's sort of clear that this all escalated very quickly in a tit-for-tat cycle. If they don't bring the tariffs way back down on China, thousands, maybe millions of small businesses will go out of business. I mean, so many companies buy from, it's $440 billion worth of goods we buy from China every year.
The Treasury Secretary told me a few weeks ago, 145%, these levels are unsustainable. What would be your advice then to the administration at what level they should set, where it still potentially is a carrot and stick approach with some businesses to move manufacturing elsewhere, but it doesn't actually put people out of work?
Yeah, you don't want to ask me my advice to the administration. I'm like a free trader. I go 0%. Let's go. Let's, open this up and let people buy from whoever they want to buy from. I don't think that's like.
What advice would you tell them then on a timeline? How quickly do they need to bring these levels down?
I think the timeline is really important. I think every day that goes by, more damage gets done. You have the 60% decline in bookings. You 25% of ocean sailings, so container ships, have now been canceled. The sailings from China to the U.S. A lot of those have been diverted. It's not a permanent move, but it takes a long time to reposition these ships back. So they're now sailing from Vietnam. They're going to Europe. They're just rerouting the container ships. So when they turn this back on, if they do lower the tariffs, you're going to see there's not enough ships and containers to move the cargo, and you're going to see prices spike because of that. So the economies are very complex systems. They're not meant to be centrally planned at the White House, and we've somehow forgot that lesson that made America so successful the last 200 years.
Ryan, thank you so much for your time this morning. John, that was Ryan Petersen, the CEO of Flexport, of course, really in the thick of this trade war, and he's in Washington, D.C. today, offering up a little advice for the administration.
Annmarie, appreciate it, but not for Amazon and Jeff Bezos. 60% reduction in bookings. How this is going to spill out to the economy, to trucking, to retailers, to the jobs market in the weeks to come is the one to watch.
Yeah, that's the reason why I'm watching toy makers in particular, since so many of them really do get their toys from China. I think some 60% have held back on their orders so far because they don't know how to price it. It just gives you a sense of how this has a longer lasting kind of tail.
Following the timeline of this, Stellantis, the CFO, saying the tariff changes are a good sign. They're talking to suppliers over using more US car parts. It takes time to get access to domestic supply. It gets time to build up that domestic supply. Up next on the program, the Facebook co-founder Chris Hughes on why Meta's antitrust trial is just the tip of the spear. 6 days of gains on the S&P 500, the longest winning streak of the year so far. 6 days of gains for both stocks and bonds. This morning, negative by 0.25% on the S&P. On the Nasdaq, we're down by 0.5. Big 24 hours coming up for big tech. You'll hear from four of the biggest names on the planet. Meta, Microsoft coming after the bell a little bit later. With 2 hours until that opening bell, let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. Just to work through some of the companies that we have heard reporting before the bell, Caterpillar being one of them, reporting in the 6 a.m. New York hour. At first, they reported lower sales volume. So what you immediately saw was a share price pre-market drop of 4%. But you can see it's up 2%. That's because buried within their earnings, they talked about this idea that even if we get tariffs as they are at the moment, even if we get a recession, they think they'll only see slightly lower volumes of sales. So that was enough to send shares higher by 2%. We also heard from another cruise line this morning, this time Norwegian Cruise Lines, bucking the trend of what we've heard. For the most part, the cruise operations have been a bright spot in an otherwise somewhat soft consumer. We heard that from Carnival, Royal Caribbean. For Norwegian, they say that the 12-month forward look, they are starting to see some softening sales. So shares there down nearly 9%. Wrapping things up with Humana, which did report after the bell yesterday, those shares moving higher by 5.33%. They're also bucking the trend in their industry. For the most part, these health insurers have said higher medical costs are a problem for us. For Humana, that was not a problem. They also beat on guidance, reaffirmed their guidance rather, and beat on profits. So those shares up just about 5%, John.
Danny, thank you. Appreciate it. Three of the names to watch in the pre-market going into the opening bell. On our radar this morning, President Trump signing an executive order easing the impact of tariffs on automakers. Trump saying at his 100-day rally, quote, "I want them to make their parts here. We gave them a little bit of time before the slaughter begins if they don't do this."
Which really highlights that this isn't necessarily a walking back of the ultimate plan here, but just a little bit of distance between how long they have to implement them. Is this the pace of travel? And then how do you start to price this into car companies that have built their manufacturing bases in Mexico, in Canada, with parts that come in from all over the world? It's going to be difficult, and it's something that is the reason why we're getting really a cloudy outlook or not at all from a lot of these car companies.
The feedback we've had over the past few months is we just don't have the domestic supply on the auto parts to provide the automakers with the things that they need. And that's going to take time to build. I don't know how quickly you can do that. Is 2 years enough?
Yeah, well, great question. And a lot of people would say that a lot of these companies are going to try to hold their breath and figure out other things before maybe there's another political actor in the sphere so that they can have long-term plans. It's a great question. And I wonder how much this was behind GM withdrawing their share buyback program to get more free cash to possibly invest on the margins in some of that capacity.
The president also saying that China deserves the 145% levies he's imposed, adding that the country, quote, probably will eat those tariffs. They were ripping us off like nobody has ever ripped us off. We've said it repeatedly on this program. By definition, the importer pays the tariff. How the cost is distributed is where we can have some debate. And what they're going to make very, very difficult, they're going to make your life very hard if you put prices up and blame the tariffs. And we saw a great example of that in the last 24 hours with Amazon.
Yeah, there was a report in Punchbowl saying that Amazon was possibly going to slap an extra charge onto certain items, saying that that is the tariff charge, and attribute it to President Trump. President Trump's spokeswoman came out and said that this is a hostile and political act by Amazon. Amazon then subsequently walked it back and said, whoa, this is never a proposal. What this shows are two things. Just how highly politicized all of the actions of these companies really are going to be. And number two, why companies do not want to speak out in any capacity. There is a culture of fear that is pervading the C-suite because you do not want to draw attention to yourself, which is the reason why the likes of Stellantis' CEO this morning are coming out and saying that what we've seen with the tariff changes are a good sign and they're going to move manufacturing back to the U.S. The tea leaves to try to say, don't look at us, we're following the rules.
The president owns the bully pulpit, and quite clearly the biggest fear in the C-suite at the moment is waking up to a message on social media about their company.
Which is the reason why the meetings that have been had are all quietly had, and any public statements have been clouded in McKinsey-isms that are very hard to interpret.
Macroeconomic uncertainty,
Yes.
things like that.
Yes, exactly.
That's the favourite phrase at the moment, tariffs. The president also continuing its attack on Fed Chair Jay Powell after promising early this month not to fire him.
And inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
In a week, that Fed chair needs to set rates again. There's a meeting, and unlike GM, we said this earlier this morning, they can't suspend and delay that meeting. They've got to have it.
And they've got a dual problem on their hands. On one hand, there's a projection of slowing growth. On the other hand, just you are seeing on the margins inflation expectations creep up, and in the expectation for inflation in the near term rising just a bit. How he addresses this really highlights how politicized the Fed is from a perceived standpoint. Whether or not they actually factor this into their calculus, there is this now extra question around what they do. And you really felt that last week at the IMF meetings, where there was this real sense of outrage. How can you just even suggest this, because it does undermine some of the credibility of the central bankers as they try to guide in an unguidable moment.
That Fed decision, a week away on May 7th. The earnings just around the corner as well. Meta set to report earnings after the closing bell as the industry faces continued regulatory pressure. Facebook co-founder Chris Hughes arguing the US has a history of striking a balance between free markets and state capitalism, writing, quote, "We organise many of our markets for the common good, choosing to cultivate them rather than plan them outright. The work is a craft, not unlike the work of a sculptor or painter." Chris is the author of the new book, Market Crafters, and he joins us now for more. Chris, good morning. Good to see you.
Thanks for having me.
Let's start big and then we can get to Meta later.
Let's do it.
The secret sauce of the US economy. How would you describe it?
It's the dance between the private sector and the government. So I make the case that policymakers have often harnessed and guided markets toward public goals in order to make Americans richer, safer, their lives more economically stable. And there's a hidden history of us doing this from the 1930s all the way to the present. It's a Republican project as much as it's a Democratic project. And we're going to have to pull out some of the lessons from that if we're going to rebuild on the other side of the chaos that's happening right now.
Talk about the chaos. So we're doing a good job of it right now.
Yeah, I mean, someone said this is more like market crashing than market crafting. And that seemed apt to me. No, I mean, this administration is at best impulsive and at worst completely disorganized. The way to do this in the right way would be to say we have a mission like bring back manufacturing jobs or even the auto industry. Then you'd create trade policy, tariffs that would be targeted, not on avocados and cars, but targeted. You'd do it in collaboration with allies, and you'd pair it with industrial policy, investments, to make sure that those plants can get online quickly and that they can do it cheaply. And there's a recipe for crafting a particular market along those lines. This is just chaos, to use the word. You don't know where the tariffs are, whether they're on this week or last week, and people are trying to figure it out.
Taking a step back, though, further, there is this feeling about what the engine of U.S. exceptionalism has been, and it's been in the worlds that you co-founded with respect to Facebook, which is big tech, and this idea that the technological expertise that has been cultivated in the United States has been superior and has been the reason why so many people have wanted to invest here. Do you see that unable to continue in this certain sort of less predictable moment, or do you see that as continuing to chug along in a healthy way that does lead to some sort of evolution?
It's certainly on shaky ground, that's for sure. I think the story of American technical leadership is also one where we see private sector innovation as a critical engine of growth paired with public sector decisions. So I'll give a crisp example. We've all been talking about semiconductors and chips for the last few years, and that's been incredibly important in bringing back advanced semiconductor manufacturing in the United States. However, the real story of how to support the high-tech industry in the U.S. starts more in the 1980s with Reagan-era industrial policy. At that point, Japan's share of global semiconductor production was increasing quickly, and there was a man, Robert Noyce, the co-founder of Intel, who teamed up with other semiconductor producers to go to Washington and say, hey, we have a national security problem on our hands. The Department of Defense agreed, so did the White House and Congress, and they came together to first do a structured trade policy on Japan to prevent them dumping in the market, and then secondly, make a big public investment in semiconductor production. So at this moment when we could have lost that technical lead at an early important moment, we invested. And it worked. A few years later, the United States retook its share of global semiconductor manufacturing. So what I'm trying to say is it's not just a coincidence that we have these high-tech companies now. And it's partially because DARPA funded the internet and the satellites are powered by the government. But it's actually something even more explicit, a product of market craft. And that should give us lessons for how we can do it in the future.
You said that the U.S. is at risk of losing some of that tech dominance. What makes you feel that about the structure of current tech companies, in particular Meta, that makes you get the sense that maybe they're losing some of that innovation or some of that structure that allows them to lead?
It's less that I think that the tech companies are losing innovation and more that you have to have public policy to be, fundamentally stable to encourage companies all across the supply chain to invest. And I think that's truly what's at risk now. I mean, you've seen virtually all the measures of investor confidence go down, consumer sentiment goes down, inflation expectations are up, equity markets are down. I mean, there's a real fear that the Fed won't be able to lower if inflation stays high. So I think all of those storm clouds on the horizon are not just bad macroeconomically, but bad for our technical companies and our leaders. It certainly makes it a much more challenging environment for them to succeed in.
If you were a sculptor, you'd be breaking Meta up, right?
I wrote a piece 6 years ago arguing that Meta had abused its power and that it had illegally acquired WhatsApp and Instagram in order to consolidate its power. The FTC under Trump filed suit on that same rationale several years ago. The Biden administration reorganized the case and continued to prosecute it. And as you know now, the case is ongoing in Washington with exactly these questions.
What is it about it that you think is illegal?
The decision in now over a decade ago to say Instagram is challenging our monopoly, our power in the social media landscape, particularly with photos, and WhatsApp later with messaging, and then to acquire those rivals and then do things like purposefully slow investment and development, as the Instagram co-founder testified just last week. That is against the law. To acquire competitors, either to shut them down or to consolidate a monopolistic position, it's quite clear. Now, the question is what do you do now? That was a long time ago. And so, in my view, I think it's important that, Facebook has to comply with the law despite making a decision years ago that was illegal. And then the question will come to what is the appropriate remedy in 2025? And we need to know more from the case to figure that out.
Is it incoherent to call some of the big tech companies in the U.S. national champions and to try to hope that they're successful while trying to break them up and change their business model with elimination of revenues from places like China?
I understand why you say that. It seems on the surface like they might be in conflict, but actually what I chart in my research is a long story of saying, wait a second, we want leading industries in the United States. So we were talking a lot about tech, but you can do it in finance. You can do it in energy. You can do it in a whole range of markets. And in order to do that, you need to use a few different tools simultaneously. One of them might be public investment, like in the IRA for climate, or in the semiconductor example that we were talking about earlier. Another might be procurement, another might be reserve buffering, and then another might be competition policy. So these things can work in concert as long as you have a clear mission. What is government trying to do? And if that's to spur, in this moment, AI research and development so that we can lead the world and take on China and be at the frontier, that could be a very, in fact, I think that would be a very smart mission to pursue. But it has to be crisp and clear, and then you can organize the institutions of American democracy to pursue that. And sometimes that might mean public investment and competition policy at the same time.
This overlaps with the idea of tariffs as well, and the idea that it was a bipartisan effort to have specific tariffs on certain products going to China that were national security concerns or just outright bans of certain types of chips being sold to China. Do you think that that is the appropriate policy in terms of limiting the amount of information? Or do you think that, as someone who's worked in the tech industry, the more cooperation and open transfer of information, the more innovation and the more people can kind of get ahead?
I don't think it quite works that simply. I think we have to be clear about what the goal is. Is the goal bringing back jobs in particular manufacturing industries, or is the goal onshoring semiconductor manufacturing for national security concerns, Or is it just a broader goal of technical innovation and leadership, like with the investment in AI? And depending on what the goal is, targeted tariffs can have a place. I mean, we saw this on, let's just use the example of climate policy. Bidenomics has gotten a bad rap, but obviously the IRA brought major investments in climate technology, not only from the public sector, but doubling the overall amount the private sector is investing as well. And that kind of investment, I think, can transform that industry. So there are bipartisan moments where people agree, more so on semiconductors than on climate, more so on tech oversight and then some other things. And I think those can be taken advantage of. And, I chart the hidden history of how to do this, because we do fail a lot of the time. Government, if it doesn't have a clear mission, if it doesn't have an institution charged with getting it done and the discretion to bring in the best minds, then it fails. But when those ingredients are there, it succeeds, and that's why I wrote the book in the first place.
Chris, this was great, and hopefully we can do it again soon. Appreciate your opinion. Thank you, sir. Facebook co-founder Chris Hughes there. How many times have we heard that? That in terms of the administration, that identify the correct problem, but the remedy to it, the approach, is maybe not the optimal one.
To me, that is the ultimate takeaway, that a lot of people agree with some of the aims, but the fact that there hasn't been a predictable, cohesive plan of how to implement it has been sort of undermining the ultimate goal.
Interesting thoughts on Meta as well. The FTC, of course, suing Meta, alleging they illegally maintained a monopoly. Those acquisitions coming up all these years later for all the wrong reasons.
Yeah, basically saying that they have a monopoly on the social media platforms of Instagram, and that was evidenced by the fact that that was what consolidated a lot of the incoming traffic when TikTok potentially was going to be banned. And it just gave you a sense of there really just aren't that many fish in the sea in this particular field.
So that legal battle continues. Equity futures right now in the S&P negative by 1/3%, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hacker. So Yahara.
Hi, John. Days after President Trump and Ukraine President Volodymyr Zelensky met on the sidelines of the Pope's funeral, Ukraine is now set to be ready to sign a natural resources deal with the U.S. Sources telling Bloomberg the agreement could be signed as early as today. Meanwhile, Amazon says it will not display the cost of U.S. tariffs on products. That after the White House blasted the reported move and President Donald Trump called Jeff Bezos to complain. Amazon said in a statement this was never a consideration for the main Amazon site and nothing has been implemented on any Amazon properties. And shares of Snap are dropping 14.5% in the pre-market after the company declined to issue a sales forecast for the second quarter, saying macro headwinds could hurt its advertising business, that overshadowing what was otherwise a solid first quarter with a beat on revenue. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next on the program, bond market volatility.
I think this is an environment where we have to kind of recalibrate to what's actually going on. The U.S. government debt levels are at, off the grid. We've never seen this before.
That conversation up next with Sonal Desai, Franklin Templeton, live from New York City. You're watching Bloomberg TV. Six days of gains on the S&P 500 this morning, a little lighter. We're softer, negative by 1/3% on the S&P. In the bond market, the rally continues. 7 consecutive days, yields are lower by another 2 basis points this morning. And on the month, yields are actually down on the month. Who saw that coming? 4.15 on a 10-year this morning. Just absolutely unbelievable. Under surveillance this morning, bond market volatility.
I think this is an environment where we have to kind of recalibrate to what's actually going on. The U.S. government debt levels are at, off the grid. We've never seen this before. We're seeing a closed economy. We're seeing signs of a closed economy. We're seeing signs of inflation. We want to see growth in the U.S. That's what the policymakers are trying to get. And all of that is likely to push up bond yields on the long end.
So here's the latest this morning. Bond yields falling for 6 consecutive days and looking to make it day 7, just 1 week out from the Fed's next rate decision. Sonal Desai, Franklin Templeton writing, I maintain my Federal Reserve call of a maximum 1 rate cut for the remainder of the year. Sonal joins us now for more. Sonal, welcome to the programme. Before we get to the Fed call, I want to start with the bond market moves of the previous month. Why has fixed income, why have treasuries traded like risk assets over the last month?
Well, honestly, John, because they are risk assets right now, because the treasury movements, the bond market movements, all market movements have been so driven by policy statements. Execution of policy is what is driving everything. And it's actually hiding the fact that the goals are not unreasonable and the tools are not necessarily unreasonable, but the execution is what has been driving bond markets. I think it's less about the fundamentals. It's more about fear. It's more about lack of knowledge. I just really don't want to use the word uncertainty. But the reality is we don't know how this is going to play out. And that is what we're seeing in market moves. The reason I haven't changed my Fed call, though, is that the underlying economy has not yet been driven to the point of an inevitable recession. But I do think that the window is narrowing to escape one. We've got another 3-4 months for a few positive developments to take place.
Sonal, we were talking with Jim Caron earlier today of Morgan Stanley, and he said that you need to have stocks to hedge your bond portfolio. Would you agree with that statement that essentially equity-like risk and in the fixed income sphere, that would be credit, is preferable to the government bond side?
Almost. Let me just put it that way. If we avoid a recession, this is probably true because the epicenter of everything that's going on in bond markets right now is government policy and potentially a huge fiscal deficit, which could be expanding. Whereas if we do not fall into a recession, corporate policies are not quite as poorly executed. So you could see that development, which is unusual, but it is possible that you don't see spreads blow out, essentially, and you get very healthy returns in your credit markets. I think one reason that they're not as good of a hedge right now is that actually equities entered this period more overvalued than bonds did. Bonds actually did not. Bonds are still overvalued by my reckoning, but not by as much as equities were as we came into this period of volatility.
Yeah, Sonal, the other thing is, and I've gotten a couple of messages about this with people angry that I haven't mentioned more, the U.S. Treasury quarterly refunding announcement, which will come out in about 35 minutes' time. And I'm just wondering how much supply matters to you at a time where it's unlikely that they're really going to try to term out this debt right now, given where the long end is.
So I think actually it is interesting because in relative terms, if you look at the treasury markets at 415, where are they expecting it to go? Absent a recession, it's not going to rally massively more. So in a sense, is this a terrible time to actually extend duration? Probably not if you buy what I believe, which is fair value being closer to 475.5. However, right now, that's unlikely to happen because I think the Treasury Secretary is very focused on not creating additional sell-offs in the long end. And any move in the direction of indicating more financing at the long end, I think is going to damage markets right now.
Particularly if you're putting a tax plan together down in Washington, D.C., Sonal. Yes. Just quickly before you go, just a word on the Federal Reserve. This time next week, Chairman Powell, what are you looking for?
You know something? Absolutely no change from the perspective of discussion. I think he will sidestep every piece of the political noise which is coming out. I think he's going to focus on the potential for inflation to pick up. I think he's going to focus a little bit on inflation expectations. And I know that we will get a weak job market, probably this, and we're going to get a weak labor market, but it's arithmetic. Not labor market, GDP print this morning, and it's pure arithmetic, right? And I think we're going to see pretty strong and robust domestic demand because it's imports which would have gone up.
Yep.
And I think he's going to use that. I think he's going to use that to essentially do exactly what we're anticipating, which is to push it out.
Look for that GDP print at 8:30 Eastern Time. Sonal, thank you. Sonal Desai there, Franklin Templeton. Coming up, Aaron Kennon of Clear Harbor, Shweta Khajuria of Wolfe Research, former Boston Fed President Eric Rosengren, and Mike Cudzil of Pimco. From New York, this is Bloomberg.
A lot of companies are quite uncertain about where things are going.
We've heard more companies talk about mitigation tactics for tariffs.
That strategic ambiguity is really aimed at other trading partners, and the message is not for the business community.
It's this uncertainty that is really, I think, killing the economy right now.
The concern is less worried about uncertainty, more worried about certainty of reality being bad.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. The opening bell 90 minutes away, and your equity market negative by a third of 1% on the S&P. This has not been the trend of the last week. 6 days of gains on the S&P 500, the longest winning streak of the year so far. We take just a little bit of this back. Over those 6 days, higher by about 8% on the S&P, and now on the month, only down by 0.9%. In the bond market, bonds are up on the month, yields are lower, believe it or not, despite all the volatility. We are on for day 7. 7 days of gains for 10-year treasuries, yields lower again by 2 basis points, 4.15. And in 29 minutes' time, you have some more economic data. GDP at 8:30. Lisa, we've got to talk about this one. Could have a negative sign in front of it. But as we've said repeatedly through the morning, that is just arithmetic. That might not speak to weakness in this economy.
Will the market receive it, though, as just arithmetic? That is the real question. How much is a negative print on the first quarter GDP, which would be the first going back to the first quarter of 2022, be received of just a taste of what's to come, even though it just is arithmetic, given the fact that a lot of people imported many goods ahead of the tariffs, and that caused a big trade deficit that translates into subtracting from the GDP. There is this question right now of whether bond yields are down for the right reasons or the wrong reasons. The economic data may give a sense in terms of just how things are going and how the market responds.
Step up payrolls Friday, 8:30 Eastern time. The estimate in our survey, 135K. The headlines of the last 24 hours, Torsten Slok over at Apollo, making the case that because the survey week was the week after Liberation Day, maximum uncertainty, all that fear in the C-suite, that you could see not just the low number, but a negative print on payrolls Friday morning.
How much was that macro paralysis evident in terms of hiring in that week? What happens in terms of the market response if this is a negative print? Is it interpreted as a one-off in terms of companies that didn't want to make any moves in light of the incredible uncertainty? I'm going to say it, even though Sonal didn't want to. Or is this a taste of what's to come? And that's why I think the market response today might be more important than even the numbers themselves.
My worry would be that people wouldn't view this as a one-off event. They'd view it as the start of a process, and that process would be ongoing through the rest of the year. That would be my worry based on one data point.
I would agree with you. At the same time, the actual data is very confusing. And when we talk to people who specialize in employment, they say it's not falling off a cliff. It just still is in that paralysis moment. And you saw that with the job openings. Yes, they are falling, but at the same time, people are quitting their jobs. So this is a confusing moment to wrap your head around, which is the reason why people are trying to look forward, extrapolate out, or not, and just want to go on a cruise.
And nothing's changed. Stocks are unchanged on the month so far. On the S&P, we're negative by a third of 1%. What a volatile month of April. Coming up this hour to wrap it up for you, Aaron Kennon of Clear Harbor Asset Management following a 6-day winning streak. Shweta Khajuria of Wolfe Research ahead of earnings from Meta, and the former Boston Fed President Eric Rosengren as President Trump renews his attacks on Fed Chair Jay Powell. We begin this hour with stocks looking for their 7th straight day of gains. Aaron Kennon of Clear Harbor Asset Management writing the path forward for both the president and the global economy is increasingly riddled with risks. I'm pleased to say that Aaron joins us now for more. Aaron, welcome to the program, sir. What do you do when the fate of this market seems to be in the hands of one man?
Yeah, it's quite remarkable. We haven't seen this during prior crises. We were trying to sort of size up the policy response on the fiscal side, the monetary side, to COVID, to the financial recession of 08-09, the dot-com bubble, and now we're continuing to size up the decision-making of one individual, and that's President Trump. But I think the market has taken some level of comfort in, and we've seen in the last several days, in the walk back that's happened. And the walk back has been happening since April 8th when he did the 90-day pause. And now even as recently as yesterday where he went to Michigan and he is creating, albeit temporary carve-outs for auto suppliers. So I think there's a political prerogative here. He's aware of that. I still think he understands that this needs to coincide with congressional support. If he's going to establish the type of tariff structure that he wants in place, and the fiscal structure, which is, tax cuts as well as regulation, he needs the support of his party. And right now they're getting a bit wobbly.
And we can describe the moment and then describe the fear. At the moment, we've still got goods, the shelves are full and we're not seeing firings. The fear is that in a few weeks' time, you might see those empty shelves and the firings might start. Feels like we're somewhere in between, and I just don't understand the timeline. Aaron, what does the timeline look for you? And do we have the time to sit here and say, OK, now it's exemptions, it's relief, it's deals, or have we already started a process that could have some negative implications in the not too distant future?
Well, I think time is of the essence for lots of different reasons. Supply chains can't be broken apart and then put back together. Shipping channels and logistics don't just sort of recorrect overnight. We learned this through COVID, and now we're creating these same challenges again. As it pertains to employment, I think, Jonathan, we noticed during COVID that there was a lot of reticence to fire. There may be reticence here to fire too. So that there could be a delay on the employment side, but undoubtedly, we're going through a period now where it's not just the soft data, it's the hard data. We saw in the PMI data, that came in quite weak. Consumer confidence soft data was the worst since May of 2020, right in the heart of COVID. So, this is a period of great uncertainty. Of course, the jobs number we're going to see on Friday, and we're going to have GDP this morning. And I think we're going to start to see that hard data play out, unless that rollback, that walk back is more severe in a positive way. I think markets will applaud that.
Aaron, if this is going to be some sort of downturn, we do see negativity in some of the economic data that we get this week. Do you buy long bonds?
It's a good question. I think, there's this whole debate around the correlation with the equity market. My view, I think we do need to set the record straight a little bit on this. If you look at the Bloomberg Barclays aggregate, which consists primarily of U.S. Treasuries and mortgage-backed securities, so, the baseline rate structure, during the period April 2nd to April 8th, when the S&P 500 dropped 12%, the ag was only down 1%. And so, I think that's an important context. And there was a great deal of volatility in the fixed income markets across Treasury. So I think if these tariffs generally hold and we don't move down towards a more strategic tariff initiative, which I think would be a very positive thing for the market, then growth is going to slow down. You're going to have inflation feeding through, and consumers are going to feel that. And also margins at the corporate level are going to feel that. And I think under that scenario, you have a reduction in rates across the board. You have the Fed in play probably starting in June. You probably have a steeper curve from where we are now, but I think generally rates move lower.
I guess another way of asking this is, at a time when there is a restructuring of the global trade order going on, do the same rules of the road of supply and demand and haven status still work in the bond market? And I ask this, we're going to get the Treasury refunding announcement. There's a real question of how much supply this market can absorb and how much that's going to change the dynamics and the pricing. How much do you pay attention to all of that in terms of understanding where to put this ballast in your portfolio, or whether it's even a ballast?
Yeah, I think, just to be clear, going super long duration right now is really sticking one's neck out. I think duration just below the Bloomberg aggregate is sort of where my head is right now. But at the end of the day, you bring up an important point. And I think that's another reason why we need some trade deals with key Treasury owners like Japan, for example. We only have a $66 billion trade deficit with Japan, but they own a significant percentage of our Treasuries. And so that would seem to be strategically, not to mention that they're an important military ally of ours as well. It seemed to me that they want to get that deal sorted out really quickly. In the European Union, let's be more strategic. Let's take out the scalpel as it pertains to Europe. Let's focus on things like automobile tariffs. Let's think about China and the strategic nature of bringing some of this important manufacturing back home. I think the politicians in Washington and the public will embrace those sorts of things. Refining of rare earths, bring that back from China to the United States, semiconductor production to the United States. And, pharmaceuticals, I think Torsten Slok put out a piece this morning that like 90% of ibuprofen that is imported into the U.S. is coming from China. That's ridiculous. I think the public can get their heads around some of that. And I think the president can declare some form of victory as well.
They're clear and obvious national security risks, and I think the administration has done a really good job of articulating that. So a lot to unpack in what you just said, Aaron. I want to pick up on one point. Are you suggesting that Japan's holdings of treasuries are part of the negotiations?
Well, I think it should be a consideration. I mean, this is a multivariable, I would hope it's a multivariable calculation. With that said, we heard it again last night. I do not believe President Trump is going to walk completely back on a lot of these tariffs because he does view it as a revenue generative exercise. I just think that if you look at Japan, you look at our imports into Japan, our exports, that there isn't a huge sort of catfight to occur in Japan as it pertains to the United States. So, why not get that deal done first? There's a strategic imperative from a military perspective, from a trade perspective, to do a deal with India. Let's get that done. And then, of course, with Europe as well. And so I think that there's a cadence that seems rational that they should adopt. We'll see if they do it.
Aaron, appreciate your time. Aaron Kennon there of Clear Harbor Asset Management. What a fascinating time for asset allocation at the moment. Tremendously complex stuff. The conversation we had just there at about 10 minutes ago with Sonal, Desai, Franklin Templeton. Why are treasuries trading like risk assets? She turned around to us and said, because they're risky. And this is the issue, and you've been bringing up the right question, Lisa, again and again and again. What's the hedge? The hedge is defined by the perceived risk. And the difficulty with treasuries is you've got to understand what the dominant perceived risk actually is. Is it inflation or downside risk to growth in the context of a moment where you're seeing massive policy volatility and people are concerned about whether treasuries are going to be in question on not just the domestic stage, but on the global stage?
Yeah, just to build on what you're talking about, the risk could be this question of dollar dominance. The risk could be foreign selling. The risk could be the issuance, the sheer volume of issuance with deficit spending, or the risk could be inflation. Then again, it could be downside growth, and then you'd want to invest in some of these instruments, the old rules, if they still apply. So you look at this and you try to understand it, and then you've got the likes of Jim Caron saying, actually, buy some stocks, hedge the bond risk.
Just amazing. Bond yields are low, by the way, so there's no freak
Yes.
out at the moment. We'll see how this turns out. How will we trade in the face of a negative sign in front of GDP? We'll see in about 28 minutes' time. We'll see if that's the number in 18 minutes' time, rather. That GDP print is just around the corner. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahara Heckes for more. Hey, Yahara.
Hi, John. Republican lawmakers will meet with House Speaker Mike Johnson today to discuss raising the $10,000 cap on the state and local tax deduction known as SALT. Negotiations on the new cap are underway, but no agreement has been reached. This as Republicans start to craft a tax bill to pass in the coming months. Kim Kardashian and Nike are teaming up to launch Nike Skims. Nike is putting together a team of executives and designers to operate it as a sub-brand. Nike Skims is set to debut a line of training apparel, footwear, accessories this spring. And former New York Giants quarterback Eli Manning is set to be putting together a group including retired NFL players to make a bid for a minority stake in the team. Sources tell Bloomberg as much as 10% of the Giants is for sale, with the stake likely to be split among a number of investors, but no final decision has been made. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. More from Yahara later on this hour. Up next on the programme, the Morning Calls, plus Shweta Khajuria of Wolfe Research looking ahead to earnings from Meta from New York City. You're watching Bloomberg TV. Is this the appetizer for the payrolls report on Friday morning? Numbers from ADP just dropping. With the details, here's Mike McKee. Good morning, Mike.
Good morning, John. Don't know how much credibility to give it, but ADP finds a disappointing April number, 62,000 jobs created. That is a lot less than the 115,000 that analysts thought they might report. It's down from 147,000 the month before. Most of the jobs lost were in the service industry, 23,000 jobs in education and health services, which have been the strength of the hiring in the U.S. over the last 6 months to 6 years, it seems like. We have a pay number for them. Job stayers saw raises of 4.5%, slightly less than last month. Job changers, 6.9%, slightly higher than the previous month. So we shall see whether the ADP numbers translate into anything useful for Friday's payroll numbers. The number that would compare forecast right now, 122,000 for private sector jobs in Friday's payrolls report.
Mike McKee, thank you, sir. We'll come back to Mike in about 13 minutes' time when we get the GDP report. That just takes the edge off any optimism going into Friday morning and maybe makes some people just a little bit nervous, waiting for a downside surprise perhaps. Equity futures at the moment on the S&P 500 negative by 0.5%. Bonds a bid, yields are lower. Lisa, we talk about this all the time. ADP doesn't matter. ADP doesn't matter. Then you see moves like that in ADP and people trade on it.
Which indicates just how much potential downside there could be should the non-farm payrolls report come in a negative territory, the way that Torsten Slok was talking about, or even just below expectations. Nonetheless, I think it is interesting that you see a rally in bonds across the yield curve. So if you're looking for some sense of whether they will rally on bad news, well, on the margins, if this is bad news, then they rallied, so maybe comfortable.
It's a small case study, a little stress test going into
Really
Friday. Some more
Esoteric.
data still to come at 8:30, as I say. US GDP just around the corner. That's the data. Here are some of the morning calls for you. First up, Wolfe upgrading Ford to peer perform, saying the latest auto tariff relief gives it a competitive advantage. There's a call for you. The stock is up by 0.1%. Your second call from Wells Fargo, downgrading Nike to equal weight, saying tariff headwinds and a mild recession will begin impacting the company's numbers in the second quarter. That name is down by 1.3%. And your third and final call from Barclays, cutting its price target on Apple to 173, expecting a tariff-induced demand slowdown. That name is down by 0.6%. Let's stick with tech. Meta reporting earnings after the market closed today. Shweta Khajuria of Wolfe Research writing, we expect a modest beat and a lower print. Our long-term view is the company's scale should enable Meta to outgrow the digital advertising market. Shweta joins us now for more. Shweta, welcome to the program. Let's talk about what we heard already from Alphabet. What's the read-through from Google to Meta?
Well, good morning. First of all, thanks for having me. The read-through from Google was twofold. One is that they did, as expected, reiterate their CapEx guidance, and we're expecting Meta to do the same for the full year, and as with Amazon this week. The second thing, and more importantly, was the read-through for advertising revenue growth. We look at YouTube first and then also search. So search revenue came in a little bit ahead of expectations, and YouTube was maybe modestly below. But when we look at share shifts and the trends implied by the reported numbers, we think that the first quarter numbers for Meta will be just fine. We're in fact expecting a beat, not a meaningful pullback on ad spend. But for the second quarter, we are expecting, now we are also looking at Snapchat's results from last night, and they dropped their guide, or they did not guide for the second quarter. For Meta now, we are expecting for the second quarter to the guidance at the high end to be about 9 to 10% year-over-year growth for advertising revenue, or for the full year revenue, which is what they formally guide to, at around 43 to 43.5 billion, which is low double-digit percentage guidance growth for total revenue in the second quarter, slightly below where the street is at.
Shweta, do you think they're more exposed to the story out of Asia? And how do you think it's going to play out in the weeks to come, given some of the tariffs we've seen?
I think that they are more exposed than Snapchat for sure, and comparable to maybe modestly more exposed than Google. We are estimating approximately, so we view it in three different buckets: Temu and Shein impact. There are some advertisers that are not Temu and Shein, but are based out of China. And then there are U.S. advertisers who source their items from China, who may also pull back. So across the three, if we add it all up, we are estimating approximately low single-digit percentage headwind to Meta's annualized top-line growth, just because we think that the auction density in itself for Meta is pretty healthy. So we do think that there is approximately a couple $2 billion or so of headwind for Meta from China-based sellers and from U.S.-based sellers sourcing from China.
Do you expect them to give any guidance with respect to the domestic issues in terms of the FTC suit and the potential for some sort of divestment of Instagram or some other remediation of that complaint?
I do not expect them to provide any detail more than what is already out there. We do expect them to appeal should they end up losing the case. But our view still holds that the FTC actually has a weaker case here just because they have already approved this. This is 10 years old. We think it's backward looking, and Meta has evolved from being friends and family sort of a communication platform to more of an entertainment sort of a lean back platform as well. So we think that they have the upper hand here, but we don't expect them to give details or even guidance around potential outcome for FTC.
Shweta, these earnings from the big tech players are going to be incredibly important for a variety of reasons. Number one, to get a read on how they're dealing with the situation between U.S. and China, but also to get a sense of how much they are doubling down on their capital expenditures. We saw from Alphabet last week that they confirmed their commitment to continue keep spending on CapEx. Do you expect the same from Meta, or do you think that it's more questionable?
We expect them to reiterate their guidance for the full year for CapEx, in part because this is more of a long-term view in terms of how they're viewing the potential demand for AI, and they want to be one of the leaders in AI. So a near-term macro headwind may not change their view on how they want to position for it. And then the second thing is that if it comes down to perhaps greater than expected macro headwinds, there is possibility that they lower their OPEX guide first. There's more flexibility there than perhaps CapEx. So we do expect, at least to start, them to lower their OPEX guide at the high end from $119 billion to perhaps a few $1 billion lower than that, but not change their CapEx guide.
Shweta, just to wrap it up, then I've got to get back to the market move. I just want to understand from you, can you point to any real examples as to how AI has actually helped boost user engagement over at Meta across different platforms? Where is that happening?
Yeah, definitely. So they have this product called Advantage Plus, and that is now creating a more than $10 billion of revenue contribution for Meta. And that is their AI-enabled service that allows advertisers to see better returns on their ad spend. The other way to think about it is that Meta's advertising revenue is growing significantly faster than the digital advertising market, even at current scale. In part, the reason why they are able to do that is how they're integrating AI, not only for the advertisers, but also for the users in terms of how much more targeted the content is across Instagram, Facebook, and Reels.
Shweta, appreciate your time. As always,
Thanks
Shweta Khajuria, thank you, of Wolfe Research. If you're just joining us, welcome. As always, looking to the companies to try and get a read on the US economy. ADP just moments ago offering you a read. It's a downside surprise. 62K, the estimate 115, and the equity market in response to that looks like this. Equity futures rolling over by about 0.75% right now in the S&P 500. An interesting aspect of the price action cross-asset is whether bonds respond and provide the offset. And this morning, a very small offset, Lisa, in response to that.
Yeah, you're seeing just down a couple basis points in the 2-year yield, 3.63%. And the 10-year yield also lower by actually more, 3 basis points. Woohoo! This does give you a really initial, and albeit a really small sample size type of move. But there is this feeling that bonds still do rally on the heels of what could be negativity around the labor market. We'll see if that holds, given some of the other data that we have coming out.
We're going to see it on Friday. I was looking at Visa earnings last night. The CEO said we have not seen any signs of overall consumer spending weakening. That comes from Visa.
You know, this is the confusing part, that you hear a different story from every company. Snap, advertising falling off a cliff. Alphabet, not so much. Everyone has a different story. You put it together, try to create your clarity, your truth. Good luck.
Session lows in the equity market, minutes away from what could be the first negative GDP print in 3 years. Reacting, the former Boston Fed President Eric Rosengren and Mike Cudzil of Pimco. From New York, this is Bloomberg. First quarter GDP just moments away. Going into it, your scores look like this. Equity futures on the S&P 500 negative by 0.6%. On the Nasdaq, down 1 full percentage point. A downside surprise on ADP, unlocking some losses here this morning, 1 hour away from the opening bell. In the bond market, yields just a little bit lower across the curve on a 10-year this morning. We're down by 2 or 3 basis points. Your yield sub 415. With your economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. We're looking now at the data coming in slowly, and here we go. The GDP kind of worse than expected, down 0.3% during the month, during the first quarter, rather. Personal consumption, 1.8%. That's a little bit better than the 1.2% that had been expected, but it is not a particularly great number compared with the 4% the quarter before. GDP price index up 3.7% from 2.3%. In the first quarter, the core is up 3.5%. From 2.6%. Now, the thing about all of this is, John, these are not the numbers that you want. The numbers that you want are going to be in the report, and I've got to dig down just a little bit here to get it, but this is important because we have this whole gold thing that comes in, so it is difficult. And there are some other issues with inventories, but real final sales to domestic purchasers are up 2.3%. That's going to be the number that Wall Street focuses on today. That's after a 3% gain in the fourth quarter. So it shows consumers still hanging in there, not as bad as the headline would suggest. Now, if we want to look at inventories rose by $131.3 billion during the month. Now, this is kind of interesting because what we had seen is a lot of stuff coming in from the import numbers and not showing up anywhere in sales or in inventories, but it looks like now they seem to have finally found them. All right. Now, the employment cost index, just let me give you a quick number on that. 0.9%, as I mentioned earlier. Wages and salaries up a strong 0.8%. Benefit costs up 1.2%. So there was a question about whether there would be some sort of inflationary impact from the labor markets, and this is a bit stronger than was expected. Finally, I feel like one of those salesmen on TV. Finally, we've got the refunding numbers for the Treasury Department. $125 billion to refund $94.2 billion in maturing securities, raise new cash of $30.8 billion. They maintain this statement that they're going to not change auction sizes for at least the next several quarters. There's a feeling that that has to change coming up. Debt limit, this is the same as last time, greater than normal variability in bill issuance. And the Treasury is considering a broad range of possible changes to buybacks, including auction sizes, but they have made no decisions yet. You can see next week we get the auctions themselves, $58 billion in 3 years, $42 billion in 10 years, $25 billion in 30 years. And the Treasury puts a note in this report that says they will offer their next X-date estimate in the first half of May. That's when the government would default if the debt ceiling is not lifted. There are a couple notes here that come from the Borrowing Advisory Committee. When we had all the ructions in the market, they said trading generally remained orderly, but they do say that the debt limit increases debt servicing costs, volatility, and risks, and they want the Congress to get rid of it.
Mike, a lot to unpack there. Let's just focus on one piece of it, and then we'll come back to you a little bit later for the details. Mike, I just want to sit on GDP. For people who aren't in the market, who aren't economists, who are turning on the television to look at this GDP print, can you briefly explain the GDP arithmetic and why what we've seen on the trade side is making this number look worse than maybe the economy actually is?
Yeah, what happened, John, was in the early part of the quarter, and this is a carryover in part from the fourth quarter, people who were worried about tariffs being placed on precious metals brought in a lot of gold from overseas to the United States. But gold is not sold as a consumer product, nor is it created, so it doesn't count in GDP. But the inventory, the trade numbers do count in GDP. They subtracted a lot from gross domestic product because of that gold. So the BEA has taken gold out of the calculation. Now, it was imported, so it has to show up somewhere, and it does look like we're finally seeing imports that were also pulled ahead, like the consumer goods last month, show up in inventory. So overall, we get this 0.3% decline, but the real final sales to domestic purchasers up 2.3%, down from what we had seen, but it isn't a complete collapse. However, I must say, politically, people are going to see the headline that says the U.S. economy contracted in the first quarter, and that could have implications, certainly these days, far beyond just Wall Street.
Mike McKee, thank you, sir. We'll be back with you in just a second. So you've got the optics, and then you've got the substance, and then you've got the market move, which is interesting because there's other things happening here at the same time. Lisa, equity still near session lows. We're down by 0.8%.
Yeah, and you're seeing bond yields actually up pretty much across the curve. What this is a stagflationary report, and that is what people are worried about. Growth, even if it isn't necessarily as bad as the headline numbers suggest, it certainly isn't robust. And you saw core PCE come in higher than expected. You saw personal consumption come in higher than expected at the same time that you have questions around the labor market. So you put this together and you have stocks rolling over and bonds rolling over at the same time. Not the test in the small sample size that we wanted to see.
This is what we were discussing 30 minutes ago, that the best hedge is defined by the perceived risk, and you've got to make your mind up. Is it growth or is it inflation? If it's both, Treasuries might have a problem.
And the Fed might have a problem, which they've been expressing, and that seems to be what the market on the margins seems to be suggesting. We'll get a lot more data. This is backward looking. Nonetheless, this is the fear that's getting baked in.
Let's get to our next guest. The former Boston Fed President Eric Rosengren joins us now for more. Eric, welcome back to the program, sir. There's the data, absent payrolls on Friday. How would you approach a FOMC meeting like the one we get next week?
Well, first, as Mike highlighted, it's a pretty noisy number. It's partly noisy because a lot of behavior changed to reflect the fact that the tariffs were telegraphed. So people didn't know the extent of the tariffs. They didn't know exactly the distribution around countries, but they did know that tariffs were coming, and there were certain sectors that you would have expected to be tariffed. As a result, many people and many firms stockpiled ahead, tried to get ahead of the tariffs. And that shows up in imports, that shows up in inventories, which is exactly what you're seeing in the data. So what it does reflect is enough concern that many people and many organizations tried to front run the tariffs. Now, in terms of going forward, this doesn't include any of the information from the so-called Liberation Day. So people didn't know during the first quarter exactly what the tariff situation was going to be. And I think most people were surprised by how significant the tariffs were. So I think what we're seeing now is the positioning going into Liberation Day, and we're going to still need some additional data after the beginning of April to get a better sense of how much weaker the economy is going to be. But I would say the high frequency data that are coming in are highlighting that the Chinese tariffs in particular are basically acting like an embargo. And that means that it's very likely that there are going to be much higher prices and some shortages of goods that are primarily imported from China.
Eric, what's the timeline that you've got in mind? So we've seen this show up in shipping and freight bookings. Now I'm starting to wonder when we actually see it show up in the shelves. When people walk into the store, when are they going to notice a difference?
I think you're going to really start seeing it towards the end of the summer. So most retailers, most stores stockpiled inventory. Again, it was highlighted by the president that he was planning on putting tariffs on. So it's not surprising that most stores tried to stock up on anything that was produced internationally that might be tariffed. So they have some inventories to go through. It takes a while to ship goods from around the world. So the combination of lags getting into the economy and the fact that there were some inventories that are probably going to shelter some of the blow, I would expect the bulk of the challenge to start being in towards middle to end of the summer.
Given the lag in time before we actually see the ramifications in the hard data, how do you understand the soft data that some people say is incredibly and increasingly noisy and other people say is a prediction of what's to come?
So things like some of the consumer surveys have shown a very dramatic change. I would say that's noisy numbers, but it doesn't mean that it's data that you should completely ignore. So I think consumers are very concerned about what the price effects are going to be and are starting to worry about how much they're going to be affected. I think a lot of people are also concerned about rising unemployment, and the ADP report, as you highlighted, was relatively weak. So I think there's going to be growing concern as we get into the summer that we are likely to see a recession. A lot of economists are beginning to predict that, and I think there is a chance, unless the administration pulls back on its tariff policy, that we will see some pretty slow growth and continued problems in the hard data as we get into the summer.
We're in the quiet period for the Federal Reserve members ahead of the Fed meeting next week. There has been, though, a lot of communication about just what they see and how they perceive the potential risks going forward of both inflation or weaker growth or disinflation among some. Do you think that at a time like this, there should be more communication or less communication from the Fed members?
Well, what you need is clear communication. And I think it's very difficult at this time to be particularly clear. First of all, we don't know if some of the policies are going to be reversed. It is possible that negotiations go well with some of the foreign trading partners and agreements are made quickly. Now, most trade agreements take years to actually negotiate. So my guess is it's going to be more of a letter of intent than it's going to be an actual agreement. But nonetheless, there's a lot of uncertainty about how long this policy sticks. And then there's the question of how it starts affecting individual behavior. These tariffs are much, much larger than anything we've seen since the Great Depression. So our statistical models don't have this kind of foreign shock in the data. So I think they're going to, and the other issue is what you highlighted in the opening, which was it's a problem both for unemployment and inflation. And that makes it more difficult for the Fed. The Fed is going to be concerned that the inflation numbers are already up and it's before the full impact of the tariffs. And if we start seeing inflation rates at 3.5% or 4%, which depending on where the tariffs end up, at least the reported data over the course of this year could get that high, that's going to make it difficult for the Fed to be reacting preemptively to any concerns they have about growing recession concerns. So it's a very awkward position for the Fed to be in. And I think they're going to move relatively slowly until it's apparent exactly what the inflation employment shocks are.
Eric, before you go, just one final question. The president went after the Fed chair again just yesterday. Does that complicate life for the FOMC in any way, shape or form next week and beyond?
I don't think it really complicates the FOMC. They're going to do what they think is right. But what it does complicate is if people are worried that the independence of the Fed is undermined, it's going to be much more difficult to finance our deficit. The relationship that you were talking about between the stock market and the bond market probably will be less correlated than in the past. And if we're not careful, we'll lose the safe haven behavior that we normally expect when an economy slows down. So it's going to limit the fiscal authority as well as the monetary authority.
Eric, appreciate your mind, as always, and your thoughts. Eric Rosengren, the former Boston Fed president, mentioning that bond market, which is getting another test right now. Lisa was talking about it. Upside surprise on the prices side, downside surprise on the growth side. Your equity market's lower by 1.3%, and you're not getting the offset in the bond market. Yields, Lisa, up across the curve.
Yeah, 10-year yields now 4.22%. That was as low as 4.14% just minutes after the ADP report. This just highlights the fear that people have longer term. Are we in a higher inflation regime at a time when the Fed doesn't have the ability to respond to weakness as much as inflation right now persisting?
We've got the perfect guest to have this discussion with. Mike Cudzil of Pimco joins us now for more. Mike, welcome to the program. Would love your reaction to what's happening both with the data and in the bond market. So let's start with this. Mike, why do you think this bond market is still trading like a risk asset?
Yeah, okay, so let's, thanks for having me. Let's put that in perspective. In any given moment in time, stock-bond correlation can certainly break down. But this year, for example, we have bond equities down 5 to 10%, and we have bonds up 3.7%. So bonds are acting like bonds if you just peel back the lens a little bit. I think the question you're asking is kind of this existential elephant in the room, which is, are we in an environment where we're starting to challenge the efficacy of U.S. assets more broadly? And we would say no. We would say U.S. assets are still a safe haven. There's still a place with excess returns. The fact that we're asking that question is somewhat concerning. It's something we're paying attention to. But U.S. assets, U.S. fixed income, still doing what they're supposed to do, which is create this ballast in your portfolio at a time where there are concerns about both growth and inflation.
Let's put the existential question aside for a second, Mike, and go to what John was asking before, which is, what's the bigger risk right now, inflation or growth worries?
So if let's take one step back. And if we look at what's happened this year, we have had a slight slowdown in growth, but still 2.3% in final domestic demand if you look at that GDP ex inventory. So an economy that's growing but slowing. But yes, the policies that are being implemented will pull growth down, push inflation up. So most likely our call for GDP this year, 0, roughly less plus. And our call for inflation this year has been revised up from mid to high 2s to 4 to 4.5%. Again, these are more stylistic than point estimates, but yeah, growth down, inflation up, feels stagflationary. All this is, as a result of the policies implemented by the administration, and those obviously can change. We've seen them change pretty rapidly. But for now, direction of travel certainly is in the direction of stagflation. Given
this backdrop, Mike, let's say we get a negative print on Friday, as Torsten Slok of Apollo is predicting. Let's say we get just a disappointing payrolls report when it comes out in 2 days' time. Do you expect long-term treasuries to rally, given the fact that there still are these inflation concerns, as we can see from today's report? Yeah. Great question. So I think, and you just had, a former Federal Reserve member on, and I think it's a good question. Ultimately, we think the stress correlation of fixed income will hold. And what we mean by that is if we do start to see the economy turn in a meaningful way, we think the Fed will react and potentially react very meaningfully. So right now we're priced for a terminal rate of the Fed funds rate to be roughly 3%. That sounds a lot like the Fed's, kind of neutral rate, and rates can go much lower than that if needed, and we think they will, even with inflation at 4.5%. Economists like to refer to that as this price level adjustment as opposed to necessarily longer term inflation. And so the question is, if we do have this meaningful drag on growth, eventually that should bring down prices. I think the Fed kind of told us they'll look through any short-term price level adjustment and need to react meaningfully if the economy returns. So we do think the Fed will react, not in May, potentially not even in June. But if the data does start to show some of these kind of meaningful slowdowns in the economy, the Fed reacts and probably quite forcefully.
Mike, just before you go, you're a PM. You don't just make calls, you've got to put money to work. Can you briefly describe for us what you've been doing, the kind of dislocations you've been taking advantage of, given all the volatility we've seen over the past month?
There's been lots of opportunity, and we think that continues. First, fixed income's attractive, whether it's on real yields, nominal yields, or relative to risky assets. So we've been adding duration in portfolios in the belly of yield curves in the United States. We've also been adding duration outside the United States and other countries like the UK, Australia, where these tariffs will be less inflationary, more of a drag. And that should give scope for other central banks to lower rates potentially even more meaningfully than the Federal Reserve. And then within the United States, we've been adding securitized products and agency mortgages over generic investment-grade corporate credit. To the extent that there is a more meaningful drawdown, we think those will be more resilient in the portfolio and allow us to play offense if something more draconian were to happen.
Mike, this was great. It's good to catch up. Michael Cudzil there of Pimco. Thank you, sir. Lots to think about here. Equity session lows were down by 1.4%. Yields up across the board. With an update on the latest data and more with your Bloomberg Brief, here's Yahara Hakes. Hey, Yahara.
Hi, John. Recapping that data, the U.S. economy contracted at the start of the year for the first time since 2022. Inflation-adjusted GDP decreased 0.3% from a year ago in the first quarter, well below the average growth of 3% the U.S. has experienced in the prior 2 years. The data also showing net exports subtracted nearly 5 percentage points from GDP. And a check on Norwegian Cruise Line holdings. Those shares are now down 8% in the pre-market after its first quarter earnings missed estimates. The company reported a 9% drop in passengers carried compared to the same period a year ago. And looking ahead, it says it has seen a softening in its 12-month forward bookings. And Caterpillar shares are rising 1.5% despite reporting first quarter results that missed analyst estimates. But Bloomberg Intelligence points out that the outlook doesn't appear as bad as initially feared given tariff uncertainty, saying backlog and orders improved double digits and the company's flat sales guidance for the second quarter is above consensus. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. The substance of the GDP print is not bad. Beneath the index, things are okay. There's a trade story. It's just GDP arithmetic. We've talked about this a million times. But the optics of the mix at the moment, Lisa was talking about it, the price mix, the output risk, going forward from here is what's spooking this market. For now, we'll see if it sticks. We're down by 1.3% on the S&P. Up next, we'll set you up for the day ahead and get the latest from the nation's capital. 6 days of gains on the S&P, gains of almost 8% on the S&P 500 into this morning. This morning, negative by 1.3% on the S&P. On the Nasdaq, we're down by 1.8. Your trading diary in the calendar into the weekend looks like this. At 10 a.m. Eastern Time, PCE data, look out for that. At 11 a.m. Eastern Time, President Trump participating in a cabinet meeting. Then at 4 p.m., he'll deliver a speech titled Investing in America. After the closing bell, earnings from Meta and Microsoft. Thursday, another round of jobless claims and results from Amazon and Apple. And on Friday, it's the payrolls report. Joining us now from the nation's capital, Bloomberg's Annmarie. Annmarie, just moments ago, the first negative GDP print back to 2022. The substance is okay. The optics not great. What's the reaction from the White House?
Right. The optics is not great when it comes to, obviously, that this looks like a weak GDP print. And under the hood, Jonathan, really gets the tension we are seeing right now with the business community and this White House. The fact that you're seeing all these retailers have to front load imports because they are so concerned about the tariffs. Later today, individuals like Jensen Huang of NVIDIA, Johnson & Johnson, Eli Lilly, these executives will be with the president this afternoon. He talks about investing in America. So he's going to want to tout all these investments coming into the United States. At the same time, these same individuals are warning against these high tariff rates that he's put out.
Annmarie Hordern with the latest from Washington, the pressure building on the White House.
Yeah, at a time when they're trying to get the PR all around, and we'll be hearing more about that with the Invest in America speech, which should be interesting in tandem with tech earnings.
And we'll react to that tomorrow. Binker Charter of Deutsche Bank, Dan Ives of Wedbush, Liz Ann Saunders of Charles Schwab, Stephen Myron, the chairman of the Council of Economic Advisors.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Francisco Cerundolo kept his perfect record against top seed Alexander Zverev intact with an impressive straight sets win to put him into the quarterfinals. The victory was the Argentine's second straight win over the German in the round of 16 in the Spanish capital and the third of his career. And don't forget, you can watch all the action live daily on Tennis Channel.